I also see gold going to 3,000 within the next period of time into the election, the U.S. election, and also within the months after that. So within the next sort of year. But what they cannot do is control the supply of gold. They can't control silver. They can't control copper. They can't control gas. They can't control food, wheat, corn, just you name it. And I believe inflation is going to continue to remain high. When I say high, I mean over the 2% band that the Federal Reserve and other central banks like to think is something they can control. So we have monetary policy, geopolitics, retail investors, central banks, all engaged in gold. Yeah, well, I think China will continue to be a major buyer or of commodities that they don't have internally, like gold.
All right, joining me today is Dr. Nomi Prins, who recently came back from a visit to Brazil, where she went to kick some rocks, basically, a look at a mine. Well, actually, Dr. Prins, this might be a good starting point for us. What'd you go all the way to Brazil to look at a mine? What kind of a mine was it? What did you think? Tell me everything.
Great. Thank you for having me on. I'm a fan of the work that you do. I was actually in Brazil for almost a month, going to various mining projects that have to do with rare earth minerals, which are, of course, right now a very important growing area in the mining space, because up to this point, they are predominantly controlled by China, with a sort of lesser extent in Australia and in Canada. And there is a growing contingent and area in the Minas Gerais, the mining region of Brazil, where there are a number of mining projects going on in the rare earth space. And a lot of that is because, well, some of those spaces have been actually there for 70 million years due to volcanic activities 70 million years ago. But what that has done is created a really interesting space for clay-based rare earth minerals, rare earth elements. And so that was something that I was exploring, and something that I've been interested in, along with speaking with members of the Ministry of Finance, Ministry of Energy, the development banks in Brazil, as well as people involved in supply chain analysis, which is, I think, a growing area with respect to geopolitics and mining, and a number of other things. I've always found Brazil, where I did my PhD and have spent a lot of time doing analysis, is a very important part of the natural resource space, of the mining space. Obviously, mining and natural resources are important to Brazil as well. And I think we're entering a period now, which is why I spent so much time there, literally on the ground and somewhat under the ground, to really have Brazil sort of incorporate its general energy policy with its natural resource and mining policies into taking, I think, what will be a bigger space on the global stage, which is going to have ramifications for where the U.S. gets supply, what happens with regard to China, and in general, this massive, I think, trend that's going to be unfolding over the next many years.
But why rare earths specifically? I mean, when I heard that you were going down to Brazil, knowing your macro outlook on things, I thought, oh, she's going to be looking at gold mines.
Yes, and I've done that as well, all over the world, including in Brazil and a few months back in Australia throughout a number of mines and such. And I think gold is obviously very important from the standpoint of, yes, geopolitics, geoeconomics, central bank purchasing, and in general, what we look at as a sort of stable backdrop, inflation fighting, wealth producing currency in a manner, although of course not as a standard now anymore since 1971. And it is an important and critical mineral, as is silver, as is copper, with respect to the energy transformation. And I also spoke with a number of copper mining people in the political space. So a lot of this trip was also to talk to where strategies were in terms of how Brazil sees its mining going forward with respect to the global community, and what it's done and where it will go. For example, mines like Vale, which is one of the number, which I didn't go to this trip, but which is one of the company, one of the major mining companies in Brazil, and certainly involved in nickel and iron and other sort of very important industrial metals. But the purpose of rare earths for me now, and looking at this as a sort of evolving spot in the mining chain, in terms of evolution, is really because of where we we are at technologically, and from the AI perspective, and from the fact that there are rare earths in every single thing that we use. The fact that you and I are communicating through Zoom right now requires rare earths. The fact that we set this call up over our iPhones requires rare earths. The fact that, you know, our space technology, our defense technology, our cybersecurity technology, and our data cloud factory manufacturing all require rare earths. And the supply is very much dominated in China, and that has national security implications and so forth. So I just think it's kind of an underwatched part of the mining spectrum with respect to the bigger precious and industrial metals, from gold to silver to copper to nickel to iron to steel and so forth.
So you're actively increasing what your portfolio's exposure to the mining space as a whole, and then zooming in on rare earths.
That's right. And I think this is going to be a very sort of exciting part of the growth of mining portfolio allocations. And also, again, where we're at from a global technological evolution and AI evolution perspective, I think this is going to be a real demand with respect to just governments, corporations, and just regular people like you and I going forward. Now this has evolved also from last year, where I always look at gold and silver and copper, and then the more used for inflation reduction and wealth management, and also industrial building metals, but also energy movements and energy transformation movements as we look towards storing energy. Battery storage and higher grade technologies for storing energy throughout the world. As we look to increasing the types of energy, there are other elements that come into play there. One is, of course, uranium, because we've had a large focus on uranium, and I talked about it sort of through all of last year. I'll continue to talk about it with respect to using nuclear power in between sort of old resources and newer ones. But battery storage also utilizes things like, obviously, lithium, which is part of that market. And there was a little battle going on when I was in Brazil between Elon Musk and lithium, and BYD, which is a Chinese company, and lithium outside of the capital, which was very interesting because there are geopolitical and mining implications to that fight, and that's going to be ongoing. And then, so we have a whole spectrum of mining, which I think is just more and more going to come into play in investment portfolios generally that haven't specifically done more than look at gold and silver and copper.
If we were to zoom in on gold and silver, though, what do you think is the most important indicator, or maybe the biggest driver that will influence gold and silver prices here in the near future?
Yeah, there's a number of things. First of all, with respect to gold, where we've hit intraday 2400, which was a key level, where we're a little bit sort of off of that, but I see that coming back, and I also see gold going to 3000 within the next period of time towards into the election, the US election, and also within the months after that. So within the next sort of year as well. And last year I thought gold would go to 2400. This period it has. Now we're talking, I think, about another percentage upside with respect to gold prices. And why? Because there's so many factors that are bearing on gold. One is, of course, there's more retail investment in gold. We've seen sort of an influx in gold ETFs. We've seen an influx in, you know, people jamming into Costco to get their gold bars, you know, sort of ordering their gold bars. There's been a much broader ability for people to both know about gold as part of their investments and also have access to gold in ways that they might not have before. It might have seemed like, oh, there's only a few ETFs. I don't really understand ETFs. Now there's a lot more, or at least I can access them. I understand them more because I'm hearing about gold. I can go to my Costco. I can buy gold coins. I was out in Australia last year when we had a mini banking crisis in the United States, which was when three banks, including Signature Banks, First Republic, and Silicon Valley Bank, all imploded around the same time. And what did that happen? What did that mean in terms of what happened? It meant that people who have bank accounts were afraid for their bank accounts, whether they were at those banks or any banks. And we still have a lot of problems going on with the regional banking system in the United States and actually around the world with respect to loans that have been given out and are getting a little bit shakier because of higher interest rates. So this means that people want to think about more where they can put their money long term, which isn't necessarily in a savings account, and trusting a bank. So we've had another sort of level of that. And of course, we have central bank buying. Central bank buying is currently something that gets discussed a lot, and I watch quite a lot in terms of gold purchasers. And in particular, central banks like China, like India, like Indonesia, like Turkey, the banks that are basically developing their own trading partnerships as well as economic growth strategies that require them to be a bit less dependent on the US dollar, or at least having something within their reserves that can be valued outside of whatever might happen with the US dollar monetary policy. And that has been increasing. There's a little bit of a flip-flop going in now between whether China, who has had 17 straight months of increases in their gold purchasing, or India, who's climbing up into those sorts of double-digit figures, is going to be the most increased reserve pile at a central bank around the world. But I mean, these are massive countries. These have massive economies. And so they have geopolitical and economic and monetary reasons for stockpiling gold. And I think that's going to continue. Also, what we've seen in with the inflation that has continued in the United States and around the world. We have a Federal Reserve that pretends to be able to control inflation. I have always believed, as I wrote in Permanent Distortion, Collusion will continue to say forever, that central banks cannot actually control inflation. They can control the cost of lending. They can somewhat control the evolution of lending and borrowing. But what they cannot do is control the supply of gold. They can't control silver. They can't control copper. They can't control gas. They can't control food, wheat, corn, just you name it. Anything that we eat or use to power our lives is uncontrollable by the Federal Reserve. And for the most part, so is housing, which they have also discussed, maybe perhaps recognizing this as something that was an issue a number of FOMC meetings back, not recently, they've stopped. Housing prices have gone down a little bit, not that much, and rents are rising. So there's basically nothing they can control. And the dampening in inflation that has been coincidental with their rate hiking exercise since March 2022, I believe it's coincidental, is just that. It's just what has happened after a massive spike, and it's letting the sort of economics and geopolitics and supply and demand natures of inflation do their thing while the Fed's pretending to control it. So that leaves gold and silver, which has had a really nice rally as sort of coming up to the levels of the acceleration of gold, as use metals that have a store of value perspective, that have the ability to not fight inflation, not protect against inflation, but just outperform inflation over the long period of time when monetary policy and central banks simply cannot as an investment. And I believe inflation is going to continue to remain high. When I say high, I mean over the 2% band that the Federal Reserve and other central banks like to think is something they can control. It might go up and down below that, it might sort of bop around that band, but in general, we are in a period right now in the world where things are not going to destabilize in terms of reduced costs. And that's something that central banks can't control. And all of this is positive for gold as well. So we have monetary policy, geopolitics, retail investors, central banks, all engaged in gold. And the interesting thing about gold, having hit that 2,400 level, and I think going through that, is we also have an election coming up. And in all of the elections in the 2000s, what we've seen is actually, regardless of who has won, a bump up in the price of gold over the 6 months following that election. There's many reasons for that, but I think one of them is that any election carries an amount of uncertainty and an amount of general apathy with respect to how voters feel about either candidates or any of the candidates in front of them. And gold has that external allure of something that is more stable and is more certain. And there has been a tendency for it to outperform in sort of mini trends after the elections, which of course we're coming up to the presidential election this November.
The central bank buying issue is of course an interesting dynamic, widely discussed out there in financial media too, typically only really at a surface level. So I've really been wondering, and you mentioned that they have their geopolitical, their monetary, and their economic reasons, both China and India, to be buying more gold or have more gold imports. And I've just really been wondering about the why of it all. And so I did some digging before jumping on this call here, and there appear to be basically two schools of thought on this, if you will. One says that China is buying up all the gold because they're preparing for a currency devaluation event, where they're concerned about the value of their own currency. But as Luke Groman pointed out on Twitter, typically gold flows out of a country before a period of devaluation, and with China, it's flowing in. Right. And so that's what's happening in the US, right? Gold is flowing out. Supposedly the reserves are just going down and lower over time. Whereas China and India see their inflows going up, which is, he claims, preparing for their currencies to get stronger. So what's your take here? Why is one part of the globe sort of loading up on gold while another one is loading off?
Well, I think it's less of a strength or weakness on currency, more of a diversification strategy for their own currencies and also for relative to the dollar, right? So the general pattern that we've seen, even in China, as they've been increasing their gold reserves every month since effectively um, the Fed started raising rates. Again, that could be a bit coincidental as well. But the point is, what they've been doing is preparing themselves to just have another store of value in their reserves in the central bank itself that can be monetized, that has actual value beyond whatever instabilities can happen to the dollar. So, for example, if we get past this period of Fed raising rates and the Fed starts to lower rates, then we have a situation where the dollar might actually devalue relative to the yen. And what that means is that the value of the treasuries that the Chinese Central Bank, People's Bank of China has on their books could potentially go down as well. Now, that said, they've also been buying less. Now, part of that is a smart investment move because there is so much supply of US debt that to continue to keep pace in a reserve capacity as a central bank with that sort of supply and continue to buy the same sort of absolute amount, now to forget percentage of treasuries that they have purchased in the past would be very, very expensive. And that's why what we've seen is China making a choice and India making a choice. Again, China holds more of our treasuries and saying, look, we're not going to keep pace with the increase of US debt in our books. We'll have enough debt so that if we need to convert it to dollars or we need liquidity or we need flow or we need to swap it out for whatever financial emergency might happen, we obviously have that. And it keeps us a player in geopolitics with respect to the United States. That's one of the reasons I think Janet Yellen was out there. We talked about it. She talked about it being because of anti-competitive things. I've always looked at Treasury and central bank conversations between our two countries as related to can you please keep our bonds? Can you please buy our bonds? Can you please not sell our bonds? Because actually that is a more expensive proposition than sort of competition in other types of technologies. And so all of this is why, from a diversification play, having gold is sort of external to the monetary reserve system right now. But they're looking at it to potentially become internal. There if they need to monetize it. Also there if we ever get to a point where there is a more standardized gold-based type of currency. I'm not saying that is around the corner. But having some portion of whether it's gold or other types of precious metals behind a currency, behind an economy, creates a stronger economy net of where the currency might be floating. So all of these reasons are, I think, part of the strategy, the growth strategy of China in general, of India in general, of their partners in general, in the developing countries to have their own external diversifying unit of wealth, unit of potential currency value, even though we don't call it a currency in their midst.
I interview a lot of companies each week on this channel. One thing I always look out for is dilution, especially obviously when it's non-revenue generating companies. And this is essentially what's happening here with China and the US treasuries, right? Because the more supply of US treasuries, the more supply of cheap paper there is, the more dilution for China to keep up at the same tempo. They have to start diversifying. Weirdly, it's kind of the same for me and my little portfolio too when it comes down to exploration or development companies. But and also as in it looks like China is just generally doing well, as in they're exporting a record amount of goods and services, with the U.S. being the biggest trading partner. So they're basically importing dollars, but what they're doing with these dollars is also notable because again, they are not putting it in treasuries, so they're not importing treasuries anymore. So they're doing something else with those dollars, including buying gold. So they're importing more gold, so exporting the dollars, importing more gold, but also other metals. It's like base metals too, copper and whatnot. So how do you see this whole thing concluding specifically for the commodity space? Like what will it result in?
Yeah, well, I think China will continue to be a major buyer or of commodities that they don't have internally like gold, and they're going to be a major processor of commodities that they do have. They are They are the largest sort of lithium base in the world, right? They do have major plans to transform their energy system. They have major plans to grow, whether it is through solar, through wind, through battery storage capacities. They have right now they're ahead of the United States and every other country actually besides Taiwan in terms of the acceleration of fabs for semiconductor factories. So they have a plan that utilizes basically anything that is mined across a spectrum of how they intend to grow their economy. I personally tend not to buy into the China's over economically conversations that come out. I think China, for a number of reasons. One, it has the ability to create funds for using for infrastructure building, for using for energy transformation, for using in technological innovations. What they haven't been doing is creating as much internally from the innovation perspective, but that is, I think, just incidental to where they can actually use their money to bring people in or to bring companies in. So I don't think China's over. And in fact, relative to the United States, where we just saw 1.6% GDP, which was lower than the prior 3.4% GDP. I mean, it's more likely that though inflation will remain persistent, to use Powell's words, but for all the reasons we talked about earlier, that our growth actually could fall relative to that inflation net, and also in comparison to where China is with respect to its inflation versus GDP figures. So I think all of this means they're going to have continued demand for all of these minerals, all of these metals that are both use metals and materials and elements, as well as gold and the precious metals that are on the sort of wealth monetary policy side. And that demand is only going to grow. They're not, again, done. This is not actually happening. And same thing with India. I mean, India has a situation, they're basically going to a fairly consistent government leader in Modi, who has very strong ideas about where India can be on the world stage, where it can be in terms of an economic powerhouse, how it exists between the United States and China in terms of both importing and exporting products and using materials into those products. And I think we're going to see more of that happening there. And then you throw Brazil into it, where you have a lot of development in natural resources that I think and China is their #1 trading partner now. They kind of flip-flop with the United States over the years since the financial crisis. And there's going to be a lot more exporting from there, and also just strategic partnerships with regard to what's there, which is why, for example, BYD, which is sort of the Tesla of China, the company is about to embark in a major sort of battery processing technology plant in the center of Brazil. And also when you drive around Brazil, you don't see Teslas, you see BYDs. And they require batteries, they require materials, and they're actually very, very comfortable cars to drive in. I was in many of them. All the Uber drivers have them, not all, but relative to Teslas. And so there's this whole world out there of demand. And of countries aligning with each other for products and for trade, where mining drives the production of these products, whether it's from energy to EVs. So I see that only continuing. I see that growing. I see that positive for the entire mining space.
I totally agree on your take that China is not done. I see it too often. I really start seeing it too often, which makes me more wary that it's the opposite, basically. Also, because when I say that they're importing obviously more metals, but what else they're doing is that they're increasing their share of outside investment. So the dollars they import, they're going to export them by buying natural resource projects in Africa, in South America, and so on and so forth. So that's something I've noticed. Are you noticing the same thing?
Yeah, no, that's an excellent point, because I think that trend is definitely growing, and I saw that right there when Elon Musk, not in front of me, but was having this argument with Lula, president of Brazil, sort of through the social media atmosphere, but in general, over how come you're basically giving your lithium and land and relationship to this Chinese company, and not me, I guess, was the undercurrent of that. And Lula was sort of like, well, it's my country. So there was other issues that came up in that, which were related to generally how the two feel about each other, that were more about sort of ideology than production. But to me, being there at the time, even though the production issue wasn't discussed, if I'm putting myself in Elon Musk's head, I'm more concerned about that, because I'm looking at potentially having a supply and processing and production in an area where there could be more subsidies, where there could be more country to country economic relationships that could hurt my relationships with China, or my relationships for Tesla's, sort of selling throughout the world, or whatever it might be. So there's a lot of yes, there's a lot of pieces in play through the emerging market, developing country, the larger countries together. And that includes China investing and physically taking up real estate, land under and over the ground in other countries as well.
Mm. And all those pieces basically flow into one big tailwind for precious metals and commodities in general, not only precious metals. That's basically the
Right.
conclusion that I'm getting out of you here. If we, so that, well, that's basically, call it the global, whatever you want to call it, East, South, whatever people call it, BRICS, basically not the West, not Europe and in the US, where both of them kind of going in a more or less an opposite direction, where mining is very bad, it's dirty, we don't want anything to do with the commodities, we only want to use them basically. Um,
Right.
with this whole idea basically that we're approaching everything, and what you mentioned previously, persistent inflation but lower growth, suggesting stagflation, if you will. How does
That's
all
right.
that how does all of that conclude for the West? Like, what is the West going to look like in the near term?
Well, there is still production going on in the West. It's just, and a need for materials.
Mm.
It's just that well, the West, with respect to the United States anyway, doesn't necessarily have a full plan as to how it's going to actually grow, right? We know we have a lot of debt. We know there are budget squabbles in Washington all the time. We know appropriations conversations happen all the time. I just spent my last week, I was in Washington last week. I chaired a briefing on a national infrastructure bank. Why? Because we need different alternative resources to finance long-term development in order to grow our economy. And that was attended by representatives from the offices of 15 different states on both sides of the aisle. So the problem with the United States, if I could just use the term problem, is that we tend not to have long-term financing in place to deal with long-term production, whether that's mining, whether it's processing, whether it's building factories or what have you. Now, some areas have changed. The CHIPS Act has just basically funneled out $30 billion worth of funds to about 5 different semiconductor companies to create fabs. Those fabs will require commodities. They'll require steel. They'll require silver. They'll require copper for their wiring. They'll require rare earths for their products. So there's going to be a large demand that follows those sorts of allocations from both the public sector, and then the private sector is going to see that and invest in that, which is going to push up commodities and so forth. So I see the economy of the United States as very fragmented, if anything. So the idea of stagflation is more the idea of fragmented growth in some places and fragmented decline, or so less competitiveness relative to other countries like China or India in other places. And I think that's going to be playing out as well over these years. And you throw Europe into this, which is historically also involved in an energy transformation, which is also involved in both, trying to grow nuclear while sort of dealing with traditional resources, while dealing with, the ongoing Ukraine Russian war. So there's a lot going on that they're grappling with as well, and I think that's going to get in the way of economic planning. And that could potentially get in the way of economic financing and therefore economic growth. So I do see more growth or strategic growth happening outside of the traditional West than inside it over the next several years to come. And a lot of that growth is going to relate to commodities, and the state of commodities and the state of mining, and the state of all the materials that are used to affect that growth. And this is where I think we're also going to be involved in a sort of larger boom of demand processing. And also, you mentioned, sort of mining being dirty and having this sort of, or at least having, this perception of problems. And that's definitely been the case. But what I have seen in some of the mines that want to be competitive, or, specifically in rare earths and other areas, that there is a significant focus on sustainability in terms of, we go into an area and we backfill it. So you don't see that it was gone, or we replant trees where we dug. Now, this is harder in large mines for things like gold, but that in general, we're looking at ways to also reduce the technology that we use to mine, the technology that we use to find spots and to go deeper and to basically allow that to be cleaner. So even though there's certain types of mining that are never going to be, quote, clean, there are also a lot of initiatives happening with the larger mining companies and natural resource companies to sort of move what is possible to move in that direction. And I think that's going to be another large trend that we're seeing in terms of just globally, but particularly where mines are located. And that's whether it's in the United States, whether it's in Canada, whether it's in Brazil, whether it's in Australia, whether it's in China. I think this is going to be a part of a move towards the technologies and even the resources to make that mining more sustainable and more environmentally and also socially friendly. I was out when I was in Brazil. I didn't visit them, but Alcoa has a large factory presence in and aluminum mining presence in an area called Poços de Caldas in the mining district of Brazil. And the municipality of this area is very positive about Alcoa. Why? Because they actually engage with the community. They discuss what they're doing to upgrade their sort of environmental and sustainable initiatives. And they basically also create jobs there. So this is an American company. It has a large presence there. It's producing, it's processing, and it's aware and gets good marks for the social and environmental and sustainable aspects to the extent that, that kind of a company can or would. So I think those are going to also help from an investment standpoint. When you look at the companies that are mining and producing and processing, who has all of those things in place in the areas around the world in which they're operating.
That's right. And this is sort of what I would call the fundamental or the long-term sort of logical thesis for commodities having a tailwind behind them, not only gold and silver, but commodities in general. There's also, though, an illogical or emotional angle to it, if you will. I mean, people look at the debt levels in the US, just instability. You look at all these charts that daily pop up on my Twitter feed showing that my parents, for example, would their paychecks would have been higher. They would have had it easier to buy a house, and then their parents would have had it easier. And we're sort of going back down that ladder, all of which creating sort of maybe a little bit of fear, which is a good driver for gold too. What are you seeing in the emotional side of the drivers?
Yeah, that's a very good point because I think we're seeing it in the younger demographics, but certainly in the sort of middle and older demographics, that idea that you're looking at your country. Uh, if we're talking about the United States specifically, with 35 almost $1 trillion of debt, and no way to really get out of that. I mean, we need to grow out of debt. We need economic growth to even beat back some of that debt, but it's never going to go away. But it's also massive. And so when you look at how perhaps you deal with your own finances, and you think about how overpowering debt is in anybody's life, whether that is student debt, credit card debt, mortgage debt, second mortgage debt, and how difficult it is to basically furnish your own debt, service your own debt, and pay interest on your debt, especially with rates going up. And then you consider, moving that up to the country level of debt. And whether you follow the numbers or even follow those, that data that you're looking at and getting on a regular basis, that's just wrong. And it's scary. And it creates a potential instability that you can't even imagine. And I think that's where that fear comes in. And with gold, you can look back through the eons and you can say, all right, well, gold has always had a value. Gold has always been able to be exchanged for other types of coinage, for other products, for services, sort of back in the day, more recently, through 1971, as a sort of standard against the dollar up until 1933 is sort of standard against generally what was being held in our treasury. And now we have a situation where gold is continuing to hold that value. Is it going to have the massive ups and downs that the stock market has as a general possibility on any given moment? Not necessarily, but what it has is a long-term stable role in sort of calming those fears and being there for an investment. You can actually, if you can't afford a gold bar, you can get gold coins and you can get authentication for those coins. And actually more and more there's more processes whereby you can authenticate what you actually might already be owning with respect to gold. And so there's this idea of tangibility, where you can see gold, whether you have it in storage, whether you can hold a coin in your hand or whatever it might be, where you don't have that, for example, with the value of a bond or the value of a paper note, or the idea that a Fed or a Federal Reserve or any other central bank can print these or create electronically these forms of fiat currency out of nowhere. And there's a value. There's a security value, talking about fear. There's a confidence value to the idea that gold has always been around, that it's always maintained its value, that it has multiple use values, whether they are simply jewelry and looking nice and giving that ancestrally sort of based and generational based chain of value, chain of wealth to the next generations. Here is what I have. Here, I'm giving it to you. I know it will have value in the future. I don't know if my bank account's going to have value in the future. And so there are all of these reasons where I think the sort of older generations are looking at whatever gold they had or whatever gold they might be adding to what they had as very, very important. And the younger generation saying, yeah, well, there's just something just very wrong in how, debt has been accumulating everywhere. And debt is not physical, but it has a very punitive impact, whereas gold doesn't. And so yeah, I think there's a psychological aspect that translates into just a long-term value. And similar with silver, a bit less so, because silver's always sort of been that sort of second cousin to gold. But I mean, it's the same idea. You have the coinage, you have the you don't have the sort of central bank holding sort of component of it, but you do have something that can be used both for industrial resources as well as a store of value, as well as from a standpoint of collection coins, and giving to generations to come as well. So I think both of those combat the idea of, well, what is the government doing? What are central banks doing? What's the plan here? And having more sort of control, at least over your own generational wealth.
You make a good point that it's not only growth, or maybe we cannot really have enough growth to solve the debt issue. At the beginning, you also mentioned that it's not only monetary action alone cannot make or break. Well, it could break, but it could definitely not make the future of the economy here. What then do you think of sort of this concept that is now, it's always kind of been around, but it's developing, becoming more profound, or I'm better understanding it, at least the concept of fiscal dominance. What does that come in your geopolitical and macroeconomic and worldview as a whole?
So when I look at fiscal dominance, the way I see it is how much seed subsidies or funding or capital will a government be able to provide in order for private industry and jobs and individuals to partake in the upside of some strategy. Again, whether it's building fabs, semiconductors, EVs, bridges, roads, port, stabilizers, or whatever it might be. So, and then obviously having some sense of, being there for the social community. So keeping Social Security, trying to find a way to make, healthcare and all of that more affordable or prudent or accessible to more people. I think these are all important parts of just general security for people, and they are roles that a government should be providing from a fiscal stimulus or fiscal planning, I should say, perspective. We've had fiscal stimuluses through like sort of emergency bits here and there, but looking at it more as a long-term plan, I think, and this is one of the things they said in Washington last week at the briefing for the National Infrastructure Bank, that our problem and something that deflates fiscal abilities is this debt. It's the fact that we have all this debt that has been issued, and we don't actually know what it is being used for, particularly with respect to financial and economic growth. You cannot link this bridge, that factory, these jobs to that series of bonds that was just issued. It's kind of just amorphous, and that's, that could be an accounting issue with respect to governments around the world and especially ours, but that's the reality. So the result of which is fiscal policy should be more accountable to to basically the rest of the budget with respect to debt. Right now, we have a significant portion of our budget, over $500 billion that goes to debt servicing payments. That's an obscene amount of money. I'm just think what that could do for the actual economy. And so a lot of this is very mismanaged and mismatched. So again, I think you can't look at fiscal policy simply in isolation, but as something that needs to be strategized with respect to also dealing with debt policy, monetary policy, and what's going on in that perspective.
Well, to a certain extent, Nomi, I hope you're right. And to a certain extent, I kind of hope you're wrong for the sake of everybody out there. I know you have to run now, though. I could keep coming up with questions for hours, but I assume you've had enough of looking at my face for now. But for people listening who want to hear and read more from Dr. Prince, they can head over to nomiprins.com. That's Nomi, not Naomi, where they will find all 4 of her books, as well as a free newsletter and a bunch of other stuff. I think the newsletter is monthly. A lot of new things get announced through it and stuff like that. But again, Dr. Prince, thank you so much for investing your time with me today. It was a great talk, and hopefully we can do this again soon and have a longer conversation next time. But I'll let you go now, as I will be moving over to the CEO barbecue portion of today's Real Money Talks, which is a weekly publication that aims at understanding what's driving the prices of monetary metals, and then go and look for companies that are looking for those monetary metals. That's the entire idea here. This week, we're looking at 3 companies, 2 gold-focused ones and 1 silver company with assets in Argentina, which is something we're talking about here before. But of course, we're not going to do any of that before I've told you that here at Resource Talks, we try to be different than most podcast channels, whatever out there. We try not hitting the viewer. It's not always as easy, but what that means specifically is that we would like you to be aware of the fact that the companies that you see on here have active and ongoing marketing campaigns. These interviews that you're going to watch are paid for by the companies as part of those marketing campaigns. This and other channels who interview CEOs, we earn our money by charging for the creation of these interviews, content creation services, and also the publication of these interviews. That's what we charge for. Although I don't make buy recommendations or sell recommendations myself, because there's a clear conflict of interest, at least in my opinion. Many of the channels and accounts on Twitter, whatever it might be, they might do that, as that is typically more lucrative for the creator. But please be aware of that fact. Anytime you're watching any type of company-specific content, be aware of the incentive of the people involved, not typically properly disclosed, including this channel. Again, and just approach this and everything out there with a healthy dose of skepticism, unless you hate money. And although I don't share questions up front, there are no questions off the table, and the companies get no say in what ends up in the final video. These things should still be looked at as advertisements. Okay, this is not research. This is not how proper research is done. And least of all, these things should be looked at as recommendations. This is not what they are. None of us know what we're doing. Otherwise, we wouldn't be making videos for the companies. We would be trading their stocks for a living. In addition, these are forward-looking, general and impersonal conversations about future events that may or may not take place in the future, depending on many different factors, both within and outside of the company's control. Please be aware of that, and please talk to a professional investment advisor before burning yourself. And please do more research before taking any decisions in the end, by visiting setterplus.ca, where you're going to find the company's official filings. Go through them, read them, understand those companies before putting any money into them. Okay, these are fair warnings, they're disclaimers. There's stuff on your screen right now that you should be pausing and reading. You need to understand these things, unless, again, you're like losing money. With all that said, though, I'm going to be starting off today with a trip to Ghana, where I'll be talking to Luke Alexander, the CEO of Newcore Gold, a gold exploration and development company. The company is listed as NCAU on the TSXV in Canada, where an average of about 250,000 shares trade each day, with a 52-week high of 32.5 cents and a 52-week low of 9 cents. With a market cap of about $56 million and about 173 million shares outstanding. Today, this is a 32.5 cent stock, so right up there to its 52-week high, and for a good reason too, which will become clear here in a minute. Adding 16.6 million warrants and 11.2 million options to those shares outstanding leaves us with about 202 million fully diluted shares. 22% of which, by the way, is owned by the board and management, and 45% is estimated to be owned by institutional investors, which means that about 2/3 is in supposedly stable hands. Looking at the last financial statement, which is dated December 31 and covers the financials for the last closed fiscal year, the company had about $4 million in current assets, most of which, so 3.7 million to be specific, in actual cash and cash equivalents, as well as some receivables and a small portion of a prepaid expense on top of all that. No long-term debt, and only about $170,000 in current liabilities in the form of account payables is to be expected. And that same statement also tells me that Newcore spent about $2.3 million over the entirety of 2023 on all types of administration expenses. That is excluding a $380,000 share-based compensation, which overall means the out-of-pocket cost on administration was about $185,000 per month on average over fiscal 2023, whereas $2.5 million was spent on evaluation and exploration, with drilling itself representing about 10% of that expense. On average, on a monthly basis, this would be almost $210,000 per month on exploring the project. And in terms of ratios, and administrative expenses represented about 48% of the total spend last year between the two, which leaves us with an exploration to administration ratio of a little over 1. As always, this is only a snapshot in time. This is a non-revenue generating company that is actively spending money on keeping the lights on, as well as developing the company through R&D, essentially. So it is your responsibility to keep track of the company's financials by visiting setterplus.ca, as well as the company's official website, and analyzing their official filings. I like numbers, you like numbers, we all like numbers, but numbers are not the only thing we're talking about here today. We're also going to be talking about Enchi, which is a 100% owned 250 square kilometer piece of land in southwest Ghana, which with a recently released PEA on it, recently updated PEA on it, better said. This PEA was done at 1,850 gold price, and it showed a $371 million after-tax NPV5, a 58% internal rate of return, and a 1.6-year payback period. That is possibly achievable after a $106 million initial capital investment, supplemented by a $92 million in sustaining capex and $18 million in closure costs. In terms of operations or operational efficiency, this now has a 9-year open pit mine life on it. It's a heap leachable project at about 0.6 grams per ton, with a 2.7 strip ratio and an 82% recovery, for a total of almost 1.1 million ounces of gold production over that 9-year period, resulting in an average output of about 122,000 ounces, which at that assumed $1,850 gold price is an average of about $56 million in cash flow per year, which is, funnily enough, as I said, where the company's market cap is right now. Positive cash flow is expected in year 2, by the way, after that initial capex has been paid, as I said, 1.6 years, or of course quicker if, and emphasis on the if, of course, but if the gold price remains as strong as it is right now, because again, remember, this study was done at $1,850 per ounce gold price assumption, with the after-tax payback period increasing to 2 years if we were to assume a $1,650 gold price, but dropping to about 1 year if we assume a $2,350 gold price, which is not too far off from today's gold price. Of course, Newcore doesn't think this is the end of the story. They actually assume that it's the beginning of this story, because the company believes there is more exploration and expansion potential here, both at depth and along strike on the known mineralized zones, as well as expanding to other zones that have not yet been drill tested. In addition, Newcore also believes that they can get better recoveries than the 82% that I mentioned earlier, and they also believe some of the other untested targets, as I said, on the project area could result in new discoveries that will then require also more work. So clearly plenty to talk about here today, Luke. And first of all, obviously, thank you for being here. But let's maybe kick it off with an overview of what exactly this year is going to look like for you, maybe in a chronological order. What do you do now that you have the updated PEA in hand?
Yeah, thanks, Antonio. Thanks for having me on today. So We're focused on obviously continuing to de-risk the NG project. We obviously put out a PEA with very robust economics, which you've touched on and we'll probably get into in a little bit more detail. So with that in mind, we see the opportunity to push this project towards a PFS. So continuing to de-risk the ounces on the project, wrap a PFS around it, and ultimately put it into construction. We're also not going to lose focus on the fact that outside of a very buildable economic project that we outlined within the PEA that will de-risk into production, we're also going to focus on the district scale exploration that we've got across our project. As you mentioned, 250 square kilometer land package. We've identified over 25 targets to date, of which we've only drilled on 9 of them. And 5 of those make up our current resource today. So lots of exploration upside, as well as we have the pits that currently constrain our resource average only 75 meters. So we've got new targets to go after, but also at all of our existing resource areas, we also have higher grades at depth that we're going to look at as well. So moving to a production decision, as well as district scale exploration, will be the big focuses for us for the balance of this year and into 2025.
And I hope we're going to talk about all these targets, or at least the majority of them. How many meters do you want to put into NG before moving into a PFS scenario, though? And how many of the 25 targets in total do you want to have tested before you actually start a PFS?
So if you look at our resource today, we sit at 740,000 ounces of indicated. So indicated ounces are what are required to feed a PFS. They have tighter drill spacing, which de-risks those ounces. We then have an additional 970,000 ounces of inferred. So 740, 970 of indicated. What we'll look to do is convert about 500,000, maybe 600,000 ounces of the inferred into the indicated category. And that's what will allow us, along with some additional de-risking work, to wrap a PFS around this project. Outside of that, as I mentioned, we've got a lot of exploration opportunities across the project. All of our deposits do remain open along strike, so systematically stepping out and adding near surface oxide and transitional ounces, which are what feeds our current mine plan. So that would ultimately extend mine life beyond what we presented within this PEA. And then looking at some of these other targets that we've prioritized across the project to do some greenfield exploration work is something else that we will focus on. In terms of the number of meters, we're just working through that at the moment. We just got this PEA out in the last 2 weeks, so we're now coming up with a drill program to both delineate, infill drill, as well as target some of the greenfield opportunities on our project.
So chronologically, you're thinking, let's wrap a PFS around this PEA and then keep expanding and then do an updated PFS before going into production. Is that kind of...
No, not at all. So all of what I'm talking about, we'll do that in tandem. So we don't need to isolate, pardon me, we don't need to isolate exploration drilling from infill drilling. We can do all of that work at the same time. And that's the optionality that we create for investors as well, is the fact that we've got a very buildable project today that we will put into production, but we've also got this exploration torque to the stock that will come through as we explore some of these other deposits. So the project we have today that we've outlined, with probably around 10 to 15,000 meters of infill drilling, we can delineate that to a PFS level, and then we would do some greenfield exploration drilling above and beyond that. We're still working on, what that looks like in total number of meters, but in the coming weeks, we will have solidified a plan and obviously come out and highlight that to the market as well.
And I think when you released that PEA, one of the main concerns that I could find online was, oh, is this enough of a mine life? Is this big enough? You probably have a number in mind, though. What would that be in terms of size? How much of a mine life would you want to see before actually saying something like, okay, let's turn this thing on?
So the simple answer is yes. It's a big enough and economic enough mine to put into production today. So one of the reasons why people look at mine life is because they need 15 years to justify building the project. So mine life is ultimately tied to the economics of the project. So let's say, for instance, if you have a 5-year payback period on your project, you need a 15-year mine life. Otherwise, it doesn't make sense to build it. If you've got a 20% IRR on your project, you probably need a 15 to 20-year mine life to justify putting that into production. The economics on our project today justify building it. So again, at an $1,850 gold price, you're looking at an after-tax NPV of $371 million. Upfront capital to build that of $106 million. So if you look at the NPV to CapEx ratio, you're looking at about 3.5 times at spot price. If we were to increase that to a 2350, you're now looking at an after-tax NPV of 630 relative to a $106 million build. I would challenge you and any of your listeners to go find another project that has those kind of economics. At 1850, we're looking at a 58% IRR and a 1.6-year payback. So again, we've paid all the capital at 1850 of this project back in 1.6 years. After that, it's all free cash flow generating, and we've got a cumulative cash flow generation slide in our deck. But over the course of 9 years, we generate at 1850 an after-tax cash flow of $524 million. So again, the mine life is tied to the cash flow of the project and the payback period. If we had a 5-year payback period, then absolutely we would need a 15-year mine life. But again, because it pays back so quickly and the cash flow generated is so high, it makes complete sense for us to build it today. That being said, from an exploration perspective, as I mentioned, all of our deposits remain open along strike. So the opportunity for us to systematically step out and add ounces to extend mine life is something that, you know, we expect is going to happen. So yeah, so, you know, we see a much longer mine life than 9 years, but for us, it makes sense to put what we've got into production today.
You're absolutely right. If the gold price were to fall about 30% from now on, you would still have a 2-year or less than 2-year payback, considering those capex numbers. And that is by any means robust economics, as long as you stay around that 2-year mark.
And again, Antonio, I would encourage you and others to try to go find another project that has a payback period like ours, has an IRR like our project, and as well as a NPV to CapEx ratio that's anywhere close to what we have. And we've been, you know, setting that challenge since the release of this PEA, and no one's come back with a project yet.
One of the ways exactly to add ounces to the story would be targeting sulfide mineralization. And as far as I understand it, based on what you've explained in news releases, if we look at the overall capex, so upfront, sustaining, and closure, for now it's estimated, let's call it about $200 million all in. And you're mining about 1.1 million ounces for that $200 million, of course, not including operating expenses, G&A, financial costs, etc. But the point is that this is a capex to production ratio of what I would call about $180, $185 of total capex per mined and sold ounce of gold. How do you think that ratio is going to change if you add sulfide mineralization, and what would that mean for your efficiency here?
So couple of things. One is we don't need to just add sulfides. Again, all of our deposits remain open along strike. So our view is there's a lot more oxide transitional material to be discovered. And we've identified a number of areas that are very prospective from that perspective. So again, the ability to throw additional ounces onto the heap leach pad is something that we'll continue to focus on from an exploration perspective. The sulfide opportunity, if you look at these greenstone hosted deposits along the Sefwi-Bibiani belt, so in Ghana, you've got two prolific belts, the Ashanti belt and the Sefwi-Bibiani belt. We're on the Sefwi-Bibiani belt. To the north of us, you've got the Chirano mine, which has a historical endowment of 5.5 million ounces, Bibiani at 6.5 million, and then you've got Newmont's Ahafo mine, where they're putting another $1 billion into it to expand it to over 1 million ounces of production, sitting at about 20 million ounces and growing. So lots of big prolific mines along trend from us. Where you see a lot of them grow in size and increase in grade is once you find these high grade feeder zones that ultimately are feeding the mineralization at surface at our Enchi project, you start to identify those high grade shoots and then start chasing them to depth. If you look at our project, we put out in 2023, we put out our first ever underground resource, about 136,000 ounces, which is not a mine today, but what it is for us is it's a proof of concept. So it highlights that we've identified some of these high grade feeder zones. So for us, going back and systematically continuing to step out, along strike, because they remain open to the north and south, as well as at depth to, further grow that high grade resource is something that we will also be focusing on. In terms of your question about, how does that impact the mine? Inevitably, what that would do once we get to enough critical mass of that higher grade sulfide, it would make sense at some stage to put in a mill to process those higher grade, sulfide ounces that sit on our project. So I don't know if that covered your question or not, but expanding the overall sulfides, and then at some stage, well in the future, putting in a mill once we've mined out all the oxide transitional and looking to go underground off the bottom of the pits is something that we would look at doing.
I suppose the question there was kind of twofold. Basically, how much more gold would adding the sulfides into a PFS or maybe an updated PA, whatever it has to be, how much more gold would that add, or could add, and how much more capex would that add? And are you going to be able to keep the same efficiency between capex and gold production here?
So we wouldn't look to add those ounces into an updated PEA or PFS. Again, the project that we have today is extremely economic, and we're going to wrap a PFS around that and put that project into production. What might make sense is in the future, and we've already done a little bit of that, we've got 136,000 ounces of underground resource, is we'll put out updated resources which ultimately grow the overall size of the sulfides. And then those, are getting incorporated into a mine plan well in the future. So, it wouldn't make sense for us to incorporate that at this stage. In terms of your question, I guess, partly about, well, how big could this get? I mean, again, if you look at these greenstone hosted deposits along trend from us, you've got Chirano at 5.5, you've got Bibiani at 6.5, you've got Ahafo at 20 million ounces. So, there's the potential for 5 million ounce plus resource here. And, that's something that we've just kind of started to touch on with some of the higher grades at depth. But wrapping that into a milling scenario at this stage, isn't something we'll look to do. Again, the heap leach mine that we've identified in this PEA is incredibly economic and justifies being put into production as it sits today.
One other opportunity is also improving recoveries, as I mentioned. So I do want to touch upon that as we move on, because you're reminding me of it now, Luke, as we speak. But let's maybe talk about, as you said, growing this thing, growing the oxide mineralization here. So growing it along strike as opposed to at depth. Or I mean, growing this by adding a new discovery to maybe. What is your, for this year specifically, what's your highest highest priority drill target, and what's sort of the geological thesis behind it? I would assume is kind of similar to what you've drilled so far, but yeah, what target are we talking about here?
Yeah, so I'll kind of answer that in a couple different ways. One is we don't all of our existing deposits, so Boyne, Sium, Niam, Quachikrum, Tokasea, all of those still remain open along strike. So we're not necessarily needing to focus on just greenfield targets. Stepping out at Boyne, for example, we've identified mineralization and drilled across about a 4-kilometer area on Boyne. That anomaly stretches for 10 kilometers. So we've kind of drilled about 40% of the anomaly. So again, continuing to step out and chase ounces in the oxides at our existing resource areas is something we'll focus on. In terms of greenfield targets, we've identified, a couple that we want to prioritize, as well as going back to Tokasea. So Tokasea is currently our smallest deposit. It represents about 50,000 ounces. But if you look at where it sits relative to Sium, we actually think it might extend right into our Sium deposit. So again, it's at 50,000 ounces today, primarily because, it's got the least amount of drilling on it. And then the high grade targets, we've got 3 resource areas that we've wrapped underground resource around. So those will be the 3 areas that we focus on from a deeper drilling perspective. And for us, deeper drilling is still only down to kind of 250 to 350 meters below surface. If you look at the average vertical depth of all the pits that currently constrain our resource, they're only down to about 75 meters. So that's where the opportunity to kind of, continue to chase these higher grade structures is something that we're extremely excited about as well.
How many meters do you want to put in all of these targets together this year?
We're putting that plan together at the moment, but around 15,000 is something that, on our initial first pass, back of the envelope type calculation we're looking at. But again, over the next few weeks, we will solidify that plan and we'll come out and announce that to the market.
How much do you think that's going to cost? $2 to $2.5 million bucks?
Yeah, I mean, if you look at Ghana, it's $85. It's about $85 per meter for RC drilling. So you do add some assay on top of that. So yeah, you're in that kind of $1.5 to $2 million for the drilling portion of 15,000. I mean, if you want to do the easy math, do $100 times 15,000 meters,
yep.
You're at about 1.5, but then add some additional costs beyond that, which gives you that 1.5 to 2 million.
Easy math is the only math I know how to do, barely. But that's RC though. What you doing some core too, I would assume.
Yeah, again, we're looking at that with our current planning. Diamond drilling or core drilling costs about $250 per meter all in. So
assays and all that.
Pardon me?
Assays and everything in.
Yeah.
Okay.
So it's obviously 2.5 times as expensive. The nice thing for us is we've got really soft saprolite material So, we can drill down to, 250 meters with the RC rig. So we can do a lot of drilling from an RC perspective, which then obviously gives us 2.5 meters for every meter of diamond that's being drilled. So again, that's all part of what we're calculating at the moment is what makes sense in terms of RC versus diamond drilling.
I didn't even know you could drill RC to depths of 250. Is that with the rock that you have now, is that is the risk of losing a hole higher than it would be if it was harder rock?
No, I mean we haven't had any issues from that perspective. So the real thing with the diamond drill is obviously having core for the geologists is very helpful in terms of interpreting the different angles of the deposit. But really, again, for infill drilling, because you're just tightening the spacing from, let's say, 50 to 25 meters. RC is a great way to do that as well. Once you've got a good understanding of what the shear is doing.
When would that drilling start? I suppose you're heading into rainy season now there. Like, how does that work? When would you start drilling?
We can drill year round in Ghana. So yeah, so we can kind of drill anytime. So again, we're putting the plan together at the moment, and then on the back of that, we'll put RFPs out for to the various drill contractors, and then look to get going. But one of the nice things in Ghana is you've got 5 million ounces of production a year in Ghana. So needless to say, there's a huge number of service companies in Ghana, and specifically, there's a lot of drilling companies in Ghana. So for us to in general, for us to get a rig onto site is a pretty quick turnaround. So once we finalize the plan, I'd like to think we're drilling within a month of having that plan finalized.
Right. Does the fact that there's going to be elections this year in Ghana is not necessarily going to slow you down or change your time frame in any way, I don't assume?
No, I mean there's a very supportive government in Ghana for mining projects. Again, it's really important for taxes. It's important for the economy. It's important for jobs. So Ghana wants to see this project built. If you look at it, in terms of all the projects in Ghana, there's a bit of a dearth of development stage projects. You've got Cardinal being built, or the Namdini project, which was formerly owned by Cardinal. That's being built by Shandong in the northern part of the country. After that, you've got a private equity group who has a project that they're just looking to break ground on. And then the next most advanced project in the country is our Enchi project. So, small example of government support within 15 minutes of us putting out the press release on April 25th, announcing the results of the PEA. We had an email from the CEO of the Minerals Commission saying, Luke, congratulations to you and the team. Great results, very economic project. How can we help? What can we do to help get this into production? So it's that kind of level of support that they're, it's just one small example of many, but that kind of level of support obviously is something that's very beneficial for us in terms of taking this into construction and ultimately into production.
Yeah, that kind of level of support, I suppose, only really happens in Africa these days, unfortunately. Do you expect that to keep being the case when the elections are a done deal? Because people hear elections, they hear West Africa, they might get a little iffy. How are you foreseeing the risk of the election to change anything for your operations?
Yeah, I mean, we don't see it as a huge risk. If you look at, I mean, all the independent groups who monitor elections globally and monitor elections in Africa, Ghana for years have all been, free and fair elections, democratic system. So, you know, from that perspective, there's a long history of it being a very very good political you know, politically safe jurisdiction to be operating in. And the other point that we make is, you know, at the end of the day, you know, don't listen to me, but look at what the major mining companies are doing in Ghana. You've currently got 3 of the top 10 largest gold producers there. You've got Newmont, Anglo, Goldfields, all with significant operations in Ghana. Newmont, as I kind of touched on, they're investing another $1 billion into their Ahafo project. That will take them over 1 million ounces per year of production coming from that asset. That will make it the second largest project within their entire portfolio, just behind the Nevada Gold Complex. So again, for Newmont to be spending that kind of money really highlights from a security perspective how safe it is, as well as from a political stability perspective and a government support that there is in country. So yeah, I mean, we're very fortunate to have amassed as large a land package as we did in Ghana. And now, you know, we're on the trail to ultimately putting it into production.
And there's, I suppose there's a risk to every jurisdiction. There's West Africa and then there's West Africa. I mean, Ghana and Cote d'Ivoire, which is a place Newmont spending a lot of money in, they're kind of considered the Germany of West Africa, if you will, the Germany and the France of West Africa. So there's a difference there too that I oftentimes talk to people about who are not necessarily well versed in understanding West Africa. But good, I understand that part. The drilling is not the only thing you're going to be doing this year. You mentioned somewhere in one of those news releases that you want to get better recoveries on what you mentioned in the PEA, which was 82%. Are you doing any kind of met work or anything else this year to get in that direction?
Yeah, so one of the things we've done a lot of work on is met test work, because as you would appreciate, Antonio, and a lot of your listeners would and viewers would appreciate, you know, having, you know, 5% of additional recovery is the equivalent of having 5% better grades, because it, you know, those recoveries ultimately drop directly to the bottom line. So if you look at the met test work that we've done on the project, we've now completed over 390 tests across, you know, the entire project. In the last few years, we've completed over 20 column tests, which is one of the key tests to ultimately come up with what your heap leach recoveries will be on the project. So in our PEA, we've got an 81.8% recovery. That is based on all of the bottle roll tests, column test work, and then we completed 2 bulk samples. So we took 15 tons of material from our Sium deposit, another 15 million tons of material from our Boeing deposit. We ran 2 60-day pilot heap leach tests on that material, and after 60 days we had 91.9, call it 92% recovery. So what that highlights is that this material is extremely amenable to leaching. So we feel that the 81.8 relative to the 91, 92% that we've been getting in our test work is conservative. And that's something that we may be able to optimize in the future. Instead of using 81.8, maybe we increase that a little bit in future studies. But with the economics that we've presented, we don't need to be aggressive on recoveries. We don't need to be aggressive on CapEx. The economics speak for themselves, and we'd rather be a little bit conservative and have the opportunity as we move into a PFS to ultimately, look at improving things in the future.
The improving that, what would that include for you? Like, is it strictly the oxide rock, or are you going to be including fresh or transition rock as well?
Yeah, so if you look at all the test work that we've done, it's been, based on either column tests. It's been based on 50-50 oxide transitional, 40-60, 60-40. So it's a blend of the two. In some cases, our transitional material actually leaches better. So it's very well oxidized transitional material. You know, so from that perspective, we're you know, the numbers are all kind of based off of column tests on both. Obviously, the bulk samples, you're digging 15 tons, so you're only getting the oxide because that's from surface. And then the sulfide material, we've done a bunch of test work on that, and we'll continue to do work on all of the material on our project. So our consultants, like Capodium, I mean, they were willing to sign off on 88, 89% recoveries, and that'll come out in the full technical report. But again, our attitude was, you know, let's be conservative. Let's go with 82%, and ultimately in the future we can, you know, we can look to add higher recoveries if that makes sense.
Yeah, you have been conservative in multiple places actually in this PEA, which I can appreciate. Maybe we can also talk about the financing package later on, because it's one thing that I wanted to make a note on. But just before we move on, maybe to that, is it typical to get almost the same recoveries on the transition material than it is on the oxide, or like what's causing it in your case?
No, again, so our transitional material is very well oxidized. So it really comes down to material type and different deposits. I mean, this tropical saprolite material lends itself very well to you know, heap leaching. So again, it's mainly driven by the mineralization that we have on our project.
So how fine do you think you have to go to get to above 90%? Not necessarily much finer than what you've done
Yeah,
now,
no.
or?
So the first 4 years of the mine plan, it's basically free dig, run a mine material. So we just put it through a screen and some jaw crushers. So that's actually one of the things within our PEA is the crushing doesn't come in until years 5 and 6. Once we get into some of the deeper transitional material, that's a little bit harder. So that again really helps with the economics of the project. We're also assuming agglomeration for all of the material on our project. So yeah, so we don't need to grind it any finer. Where, you know, grinding it finer often is the case is for CIL, CIP plants. Whereas we're actually, you know, we've got material that we don't need to grind any finer, because it is that kind of run of mine material in the first few years.
So even if you are able to get higher recoveries into the PFS, that's not going to change the split between upfront capex and sustaining capex.
No, we don't anticipate it would. No, it's literally just a matter of us, you know, going, okay, well, let's use the higher numbers that our consultants are encouraging us to use.
Yeah. Yeah, I like that, because there was one thing that I wanted to ask you about was like how come upfront capex and sustaining capex almost the same time? Typically, you see all the capex being weighted up front. So essentially,
So
that
the
is probably
big,
something else too, right?
yeah. So I think at the start in your intro, you mentioned life of mine capex of around 200. So the life of mine capex is 216 million. That doesn't include any salvage value. So, you know, your 200 is probably a little more accurate because there would be some salvage value component. But again, that's not going to make a difference in an NPV model in year 9 or 10. But so that 106 million of upfront capital, there's another 58 million of crusher installation that goes in years 4 and 5. That's where the crushers are installed. So that 58 million goes into sustaining capital, and then obviously adds to the overall life of mine capex. But the big thing is, you know, you obviously not taking that on day one helps the overall NPV of the project. So again, we're very fortunate that we do have the material type that we do, that we don't need to be crushing from day one, because it saves us 58 million of upfront capital.
It also makes for potentially a cheaper financing package because you can pay for that plan using cash flow, hopefully. And
Well,
that
no,
would
no, no. So sorry, Antonio, just be clear on that. So that 58 million is fully funded from cash flow. So if you go in and look at our presentation, we've got a cash flow chart in there, and you'll see in years 4 and 5, the cash flow isn't as much as it is in other years, and that's because the cash flow from the project is paying for the 29 million in year 4 and the 29 million in year 5. So you'll see in years 4 and 5, our all-in sustaining cost goes up to around 14 and 1200, but that's a direct result of the crushing capacity being paid for by cash flow. So our life of mine capex is fully funded, obviously, other than the 106 million of upfront capital. Important to also highlight that 106 million of upfront capital does include a 20% contingency. So we've got obviously a contingency in there. And then also, I don't know if you want to talk about the engineering firm we use, but Lycopodium is the group that we worked with, who is probably a household name to a number of your viewers. But they've done a lot of work in Africa and in West Africa. If you look at the last dozen projects that they've worked on and constructed, they've either come in on time, ahead of schedule, on budget, or under budget. We've got a slide in our presentation that lists all the project, but these are projects that have been built by Endeavor, B2, Newmont. So, all the big firms out there use them. They're actually working on that Newmont expansion in Ghana. So they're one of the lead engineers for that $1 billion investment that Newmont's making. So obviously we leverage that entire database of information they've got. We've received quotes from multiple different suppliers in Ghana and in West Africa. So the numbers that we've presented in this PEA are obviously very robust economics that are backed by arguably the best engineering firm to be operating in Africa today.
Right. Yeah, I saw that. And that's the point that I wanted to ask you about is looking at these projects that they've done studies on. I know it's typical to use a 5% discount rate to that MPV for precious metals project, 8% projects, 8% for base metal projects. What do you think the realistic financing cost here would be? Like, do you think 5% in this interest rate environment is doable?
Yeah, so two things just back on the Lycopodium point. So these are studies that they've done, but they're also projects that they've built. So that's an important distinction. So they'll actually build and manage some of these projects as well. So because there's obviously study work and then there's constructed projects, and we've seen that go very wrong for a lot of different companies in terms of what they presented from a feasibility perspective and what the costs ended up being. In terms of the 5% discount, I mean, that's typically what's used across the industry. So for investors to be able to compare projects on an apples to apples basis, having 5% is important. One of the things that we've seen is Africa has been able, a lot of projects in Africa have been able to get good funding terms. There's a number of examples of that. There's different African banks who are very keen to lend to these types of projects. But I'd look at something like this because it is low risk, quick payback, big NPV to capex ratio. I mean, those are all very attractive things for lenders in terms of coverage ratios from a cash flow perspective. So it's, in my view, an ideal project. Also the size, 100 million instead of 400 or 500 million for some of these other projects. It's something that a lot of different groups can get involved in. So, it's too early to kind of comment on what exactly I would expect, terms to look like. But I think if you look at a number of the projects that have been recently financed, we would be at, or I would even suggest below some of those levels, given those various metrics that I just talked about.
Yeah, I can absolutely agree with that. And that's where that question was coming from, to kind of understand how you think about this. Who do you think eventually builds this thing? I mean, do you have the aspirations to get it into production yourself, or do you think someone from your neighbors might start getting interested soon?
Yeah, I mean, we have a team that can put this into production and is moving full steam ahead to get it to a construction decision and ultimately build it. And we've got the support from our major institutional investors who recognize, the value of this project, the cash flow that it generates. So that's our focus, is to get this into production while continuing to also, drill some of the greenfields exploration targets on our project. That being said, as you move a project along, as you de-risk it through the various stages, inevitably, often, a producing company will come along and say, hey, this is such a great project and we want it within our portfolio. My job and the management's team job is to explore all the different avenues that are out there. And if someone does come along, it's to then take that to our shareholders and let them decide. I mean, at the end of the day, as CEO, I'm a steward of our shareholders' capital, and it's not for me to entrench myself and decide that, hey, I don't want to do any deal. So if someone comes along, then we take that to our shareholders and we ultimately let them decide. In terms of where the project sits today, we see a huge re-rating opportunity as the market starts to price in the value of our project. So we think there's a lot of room to run here for the stock. But again, if someone comes along, my job is to take that to our shareholders.
Good. Yeah, that's a fair answer. I was mostly thinking about, in terms of production profile, who do you think this asset fits with? Like, is this an Endeavor asset? Is it a B2 asset? Is it maybe a new?
Yeah, so I kind of put companies into a couple of different buckets. You've got, the large seniors and large mid caps. I mean, as you just mentioned, the B2s, the Endeavors, the Newmonts, the Barricks of the world. To move the needle for those types of groups, you're looking at, 250,000 ounce plus type projects. Our project today is not at that kind of size and scale. So it would more fit with, a single asset or two asset producer who's looking for a project that generates a huge amount of cash flow with district scale exploration upside. So, that would more likely be the type of group that would be interested in this type of a project today.
You bring up a good point when you say a single asset producer, because you're currently a single asset explorer / development company. Any plans to start looking at changing that anytime soon?
I mean, if I keep harping on it, but if you look at the economics of this project, they're so robust, we can't find another project that has economics as good as this. So why would we go and dilute ourselves with another project when, for us, at a, call it $40-45 million US market cap, we've got a project with economics that stand above anything out there that I've seen. So again, that's the challenge I put to you and others is, find us another project that has economics that are as good as the ones that we've presented within this PEA. And, we can't find it. So with that in mind, our focus needs to be on putting this into production to start, re-rating the stock towards a producer instead of, a development stage project.
How much finder's fees are we talking about if I find you a project tomorrow?
We ultimately believe in meritocracy. So, if people create opportunities and bring ideas, then we're obviously happy to align ourselves with them.
I was only kidding, but now you're bringing ideas into my head, which is not a good thing. I might faint What are you are you making any new hires or anything?
Antonio, the issue is I don't think you're going to be able to find one. So
Good
you're
point.
probably better to just go buy some more stock and then you can make the money off of that instead.
Touche. Are you making any new hires this year with what you want to do, or expanding the G&A in any way?
So we hired a gentleman by the name of Brandon Fraser in September of last year. So he came in as our VP project. He's a mining engineer by training. He's built heap leach projects around the world. He's helped design and consult on different heap leach projects. So we brought him in. He really wrapped his arms around the project alongside Greg Smith, our VP exploration. So and working alongside Lycopodium. So at the moment, we've got all the kind of bench strength we need to fast track or move this towards a PFS. And then we've also got a great team in Ghana, headed up by Dan Wilson, who's our country manager. There's 2 mining universities in Ghana. We probably get a couple hundred resumes through our inbox a month. So there's lots of talent around for us to leverage off of as and when we need to add additional personnel. But at the moment, the team we've got is a very capable team who can move this to that PFS stage.
Well, why I'm asking that is because I'm interested in just calculating the G&A here. You did about 180 a month last year on average. What are you thinking this year? 200, sort of that same range, or?
I think it's in and around that range. And the only thing I'd just kind of add to the G&A is obviously, the G&A obviously includes a lot of the exploration team, the project team. So all of those aspects are obviously, moving the project forward in terms of, de-risking it, putting out technical studies, all that type of work. So drilling one layer deeper on the G&A side of things is also helpful because, again, for us as a management and board, we own 22% of Newcore. So our view is we want as much money going into the project as possible because that's where we see creating the most amount of value. So again, depending how you look at that number, a lot of that money is being spent again on moving the project forward in terms of exploration, development, that type of work as well.
Well, where I'm coming from with all these money questions, if you will, is just because I'm wondering, when do you go for a raise? You had 3.7 million in cash and cash equivalents at the beginning of this year. It's 4 months later now. You've spent some money here and there, obviously, to complete what you've completed as well as G&A. But the share price is at a 52-week high and more than that even. So I'm thinking, would it make sense to start working on a financing as we speak?
So the other piece I would add to that is we've got about $3.3 million of warrants that are well in the money. Those expire at the end of June. So those expire in about 6 weeks from now. Strike price is 20 cents per share. Last week, we actually had $1 million come in from the exercise. And, I'd expect all of those warrants to be exercised. So, if you take your 3.7 and you add 3.3, you're looking at about $7 million of cash. We burn about $1 million per quarter. So if you go back to, our prior quarter, September end, we were at about 4.9. We ended the year at 3.7. So that's about $1 million a quarter. So we're 4 months into the year. So knock $1 million off the 7. So, sitting around 6 million of cash that we'd expect to come in from the exercise of those warrants over the next 6 weeks. So, we're sitting in a nice position from that perspective. Obviously, moving the project forward, drilling, all that kind of stuff, we will look to, come up with a plan on that front. But there's, no real rush for capital based on where our balance sheet is today.
Good. Well, Luke, this has been a good overview. I know you have to run now, but what am I forgetting to ask you here? What did you come here hoping to talk about, but I'm not bringing up?
No, I think you asked a lot of really good questions. I mean, Again, if you look at Newcore today, it's trading around $45 million US. That's about 0.1 times the NPV of the project at an $1,850 gold price, less than 0.1 times the NPV of the project at a $2,350 gold price. So we see a real fundamental re-rating opportunity for the company as the market starts to price in the value of our Enchi project. We've got a very supportive government who wants to see this project put into production. And I think that's a key differentiator, is the amount of time it'll take us to put this into production relative to a lot of other jurisdictions who have much longer permitting timelines than what we're looking at in Ghana. Backed by a management team who are truly aligned. So we own 22% of the business. So we're aligned with shareholders. Great institutional support, 45% ownership, and then district scale exploration. So we've got big exploration torque to the upside as well. So I think we kind of touched on a number of those points. I would encourage anyone who wants to learn more about Newcore to look us up on our website. We've got a detailed PEA presentation in there, as well as a corporate overview, as well as social media. We're active on X and LinkedIn and Twitter, YouTube page. So lots of content there that people have found really useful as well.
Good. Yeah. Yeah, well, you are indeed active across those platforms. I was actually using some of that as part of the research for the questions you'd see. And hopefully you'll be active on resource talks as well, Luke. I'm looking forward to more conversations in the future. You keep me up to date with whatever's happening down there. Hopefully not too far off in the future either. I will let you drop off now, though, get to your work here, Luke, as I'll be traveling to Argentina to revisit a story, a company I've spoken to a couple of times. Last time was a couple of months ago, with that being Abra Silver, which is our silver exploration and development company for this week's Real Money Talk. Who, again, this company, friendly reminder, has paid for the production of this interview, but I don't share the questions up front. No questions are off the table, and the company gets no say in what will end up in the final video that you're watching or listening to. The company is listed as Abra, so that'd be ABRA on the TSXV in Canada, where an average of about 1.5 million shares trade each day, with a 52-week high of 48 cents and a 52-week low of about 25 cents. With a market cap of about $293 million and about 624 million shares outstanding. Today, this is a 45 cent stock, adding 16 million warrants and 25 million options leaves us with about 665 million fully diluted shares. Importantly, 2 million of those warrants expire about a month from now on June 6th, and they're exercisable at 37 cents, with another 14 million warrants expiring 6 months after that at 50 cents, for total potential proceeds of almost $7.5 million. The 25 million options are ways away, by the way. They expire in February of 2028, but they're already in the money as they strike at 25 cents. Eric Sprott is a large shareholder here. He holds about 10% of this company, whereas other famous names like Kinross Gold and Central Puerto hold another almost 10% together, so that'd be 4% each to be specific, and management also owns 4% of this company. Looking at the last financial statement, which is dated December 31 and covers the financials over the last closed fiscal year, the company had about $5.3 million in current assets, most of which, $4.38 million to be specific, was in actual cash and term deposits, as well as some receivables and a small portion of a prepaid expense on top of that. In terms of debt, I'm looking at about $7.4 million estimated for a consideration payable with regards to the Ablilos project, which might become more clear further on in the conversation. And there is about $780,000 in account payables with no other debt. That same financial statement tells me that Abra spent about $4.6 million over the entirety of 2023 on all types of administrative expenses, and that's excluding a $1.7 million share-based compensation, which overall means that the out-of-pocket administration cost was about $380,000 per month, whereas $23.2 million was spent on evaluation and exploration, with drilling itself representing about 60% of that expense. On average, on a monthly basis, this would be almost $2 million per month on exploring the project. And in terms of ratios, administrative expenses represented at less than 17% of the total spent last year, which leaves us with an exploration to administration ratio of about 5. Now, two things. This is a very active company, so the balance sheet and the cash flow statements are going to be different for 2024, especially considering the stage at which the company has arrived at, as well as a recent $20 million strategic investment that came into Abra from Kinross, and that other company, another thing that will be discussed later on. So please understand that this is only a snapshot in time at the end of last fiscal year, and head over to the company's website as well as setterplus.ca to look at the numbers for yourself. We all know and understand that accounting is the most fun a human can possibly have, but that's not everything in life. And for Abra, there are also 2 projects that are important here. Although a couple of more in their portfolio, there are 2 that are of focus right now. And the vast majority of the capital that I talked about last year, about 80% of it, was spent on Diablilos. It went into that project, which is an almost 80 square kilometer piece of land in the Puna region of Argentina. There are multiple deposits that make up the overall resource here, driven by a high sulfidation epithermal silver gold mineralized system. And why spend so much money on it last year, though? Well, because John here was working on getting a pre-feasibility study done. So a PFS was done on the project after having drilled over 130 kilometers into it and having spent over $55 million on it over the last couple of years. That feasibility study will be part of the conversation today, a big part of it too, as it came out on March 25 this year, so a few months ago. And it was calculated at $1,850 gold and $23.50 silver, showing an almost $500 million NPV5 and a 26% internal rate of return after tax, I mean. But come on, what's the difference? Now, those economics are possibly achievable after a $373 million initial pre-production capex with a payback period of about 2.5 years, supplemented by a $65 million sustaining capex. After that spend, a conventional open pit mine here is expected to operate for about 13.5 years with an average strip ratio of about 6.5. And this is oxide mineralization, so we're talking about a heap leach operation. Abra doesn't think that this project is done for, though. They believe that there is more exploration capacity along strike, which is why they'll be exploring it more this year. And they also believe there are improvements in the mine plan efficiency possible, again, to be targeted this year, which is why a 20,000-meter drill program has been announced this week, with this being the 4th drill program that the company is going to do, aimed at both areas with known mineralization as well as looking for more mineralization within the broader land package here on a roughly 75 to 25% split, with 1 drill rig turning over there already and 2 more being expected to be added over the next couple of weeks. All of this is now fully funded after Kinross Gold and Central Puerto came in on a $20 million financing, as I mentioned earlier, with each one of them taking a $10 million position in Abra Silver at 40 cents per share. And Abra, by the way, now also plans to consolidate its shares on a 5-to-1 basis, so the share structure I walked you through earlier will soon look different as well. Although the focus of the spend and the effort here at Diablilos is not the only project, Abra's portfolio, as I mentioned earlier, has a couple of more projects, and they've also just recently started drilling at La Coipita project, which is located in the San Juan region of Argentina. It's the same famous belt as Filo del Sol and Los Azules, so that means that this is a porphyry target that has shown some mineralization over its relatively limited 2022 and 2023 drill programs, as well as potentially promising geological fingerprint, but nothing major to write home about so far. And this year, 2 rigs are drilling there. Planned 4 holes is going to be drilled over 2,600 meters of drilling. Interestingly, all of which funded by Teck Resources after an earn-in joint venture option agreement was announced at the beginning of the year, which could give Teck 80% of La Coipita if they spend at least $20 million in exploration expenses over a 5-year period, which while also making a $3 million cash and shares option payment, and they are going to be operating the project themselves. There are a couple of other things going on that John and I will be discussing later on, but this seems like a good time for me to start shutting up. But let John do the talking. And John, let's start with this. Let's maybe start with the price reaction to the stock here, to the updated, to the PFS, because initially when you announced this PFS, the market actually closed in the red, I believe, that day, and I was surprised by it. And it has since started going up with the silver price and all that, with a few high volume days after the Kinross announcement and all that. But how do you explain this price action to the PFS, John?
Sure. Well, first off, thanks very much, Antonio, for having me back on. It's a pleasure providing an update and very, very comprehensive intro there. So I'm not sure I have much more to add, but happy to answer a couple of questions. Yeah, no. So in terms of the pre-feasibility study was announced back in March, late March. We were extremely pleased with the results. Did a lot of marketing on the back of that with existing investors, prospective investors, and I'd say almost unanimously. I mean, all of the feedback we received was positive. Everyone was very pleasantly surprised, I'd say, with the exceptional high grades, especially in the first 5 years of the mine plan. CapEx did not blow out. I mean, this is still sub $400 million US in terms of capital costs. And, you know, the capital cost estimate was based, 80% of it was based on actual contractor quotations, so direct quotations. So we weren't benchmarking or, you know, this was a very, very thorough update. And so, yeah, I think generally the overwhelming feedback was very positive. I'd say what limited the share price performance was that, you know, most investors were, you know, I guess realized that we would need to do a capital raise this year. And so, you know, the focus of every conversation shifted quickly. Okay, you have a great pre-feasibility study. Now you're obviously going to need to raise money. You know, I think the concern was we would do a dilutive financing at a deep discount, issue warrants, et cetera. And so, you know, that obviously was not the case. And so thankfully, as we announced our financing with Kinross, with Central Puerto, two very long-term strategic investors that are also now partners. We have various committees set up with them, et cetera, at a premium with no warrants. You know, I think you saw sort of the ceiling was, you know, was removed from the share price. And finally, the share price after that announcement started to breathe again. But yeah, I think we're set up now remarkably well. I mean, I'm extremely bullish. The company has a very, very strong cash position, over 24 million in the bank. So we're fully funded. We just recommenced drilling. This is going to be a very, very exciting exploration campaign for us, multiple targets, which I'm sure we'll cover. And you know, I think we have the benefit of having some strategic investors in us as well now. So lots of upside potential here. And I think the market now is kind of starting to play a little bit of catch up, but we still have a very, very long ways to go.
Good job on that financing. I have had my fair share seen my fair share of bad financings this year. Got burned myself on one. And I like how he did this, especially where everything was going right after PFS and all these things. Yeah, so good job on that. I like how the market's also reacted to it. So the market is clearly recognizing the value in it together with the prices of the precious metals that are going up. When we talk about you bringing up financing, and I'm already thinking maybe 2 steps ahead, but I'm thinking about financing this thing before you can make it a mine, actually. How do you think that's going to look like? Are you thinking a traditional debt and equity financing, or do you think you can get creative where, you know, you're bringing in royalties as well, streaming or something else?
Yeah. Yeah, no. So as a junior, I mean, you always want to have lots of options available. And this project really, really bodes well. We have a lot of options available. So first off, I mean, the capital cost estimate that we announced in the pre-fees assumes that you build this as a you know, carbon and leach plant, cyanidation, but the plant size is 9,000 tons per day right out of the gate. And so this is a large scale project right out of the gate. Now, the CapEx is just under $400 million US, so it would not be huge relative to other projects they have this size, this scale. But certainly for a junior company, financing 400 million US would be extremely challenging, I would say. But what really bodes well is that we have the optionality here of potentially starting off as a low-cost heap leach. And so that's one of the studies actually that we're about to embark on right now. So we have a lot of material that was just below the cutoff grade of the pre-feasibility study. And for the purposes of the pre-fees, we treated all of that as waste. And there was, you know, call it 40 million tons of about roughly 0.3 grams per ton of gold. It was mostly gold. There was a little bit of silver as well, but not material grades on the silver side. So it was mostly gold. And, that was essentially all just treated as waste. We're saying, let's not focus on that for this study. Let's treat everything above 45 grams per ton silver equivalent, which is a relatively high cutoff grade. And so right now, we're going to start on a new study looking to process that material via heap leach. So you have to mine this material anyways. It's sort of the pre-strip at the Oculto deposit. And so instead of mining that and moving that to a waste dump, you mine that and you put it on the heap leach pad. And then with average recoveries of about 70–75% on the gold side, which we think is achievable, you could be recovering almost another 200,000 ounces of gold here. So as a junior, I'd say it'd be much more economic to start this off maybe on a heap leach basis. Your capital costs would be, significantly lower. Obviously, we'll have to update all the studies, but you'd be looking at less than $200 million to start this off as a heap leach. Then you start generating some free cash flow, and then you can scale up. And then maybe you build maybe a 4,000 or 5,000 ton per day plant, and then eventually maybe scale it up to the 9,000 ton per day scenario that we published in the pre-fees. So there is optionality here for a junior to build this. Obviously, that's something we'll consider. And then, yeah, like you said, we can consider a gold stream, a silver stream. You can consider bringing on debt. And, all of those options are going to be evaluated at the right time, which is likely going to be sometime in the second half of next year, 2025. But for now, we're focused on drilling. Let's keep drilling. Let's keep growing this as we've been doing in the past. I think our team's been very, very successful through the drill bit. And, we're obviously very focused on that for the time being.
So you're thinking an updated PFS basically by the end of last year? Next year. What am I talking
for
about?
this optimization study, yeah, even before the end of this year, we could look to to do another optimized study, which looks at various changes, potential that heap leach. There could be some tax improvements as well in Argentina. We're monitoring the situation there very closely. Javier Milei has proposed a large reform package with some very major incentives for large investments in Argentina, which this would obviously qualify as. And so for large scale investments, looking to lower corporate taxes significantly, it's looking to reduce export duties, eliminate royalties, etc. So that could add hundreds of millions of dollars to the net present value. And so, that could be incorporated into this study as well. So yeah, no, that's something that we're kind of starting to work on, and, we could accelerate that work as needed.
When you're talking about sort of a starter operation, if you will, here at first, do you think there could be improvements to the strip ratio as well? Because the strip ratio I mentioned here, 6.5, is over the life of mine, but it probably would look different if you have a starter operation.
It would look dramatically improved. So that would come down to about 2.5 instead of 6.5. Wow. So there's a huge amount of tonnage. I mean, 45 million tons is basically all of the tonnage that we have right now classified as reserves. We would essentially double the reserves here. So you're going from 45 million tons to almost 90 million tons today. And then obviously your waste comes down by about 40 million tons as well. So it's a significantly improved. Now, this is lower grade. Obviously, you're not doubling the amount of ounces. But yeah, it significantly improves the strip ratio and obviously the economics as well, we expect.
I also assume that you believe, and I would also tend to agree, that this makes you a more attractive takeover target for someone like Kinross, because they've come in on this, right? So how do you look at that? I mean, what do you have in mind? Do you have in mind, like, let's do this, and 1 to 3 years from now, we're a very attractive takeover target, or do you think it takes longer for that before these parties start getting more interested?
Yeah, I'd say, look, I've been doing sort of corporate development my entire career, so 20 years now on the mining side. So I've been involved in a number of transactions for sure. And so it's next to impossible to try to time these things. I mean, from our perspective, we're open to discussions down the road at the right price. Right now, we're trading extremely cheaply. So based on the current pre-feasibility study, we're trading at less than 0.3 times our NAV. So a price to NAV ratio is less than 0.3. I mean, typically, sort of in better parts of the cycle, you see high quality projects trade at north even of 1 times NAV or very, very close to 1 times NAV. And so from our perspective, right now, the focus is not on M&A. The focus is on let's drill, let's continue to grow this, de-risk it, get the permits, move this closer and closer to a construction decision. And as we do that, we think the share price naturally will play catch up. And especially as gold and silver prices hopefully continue to improve here going forward, much higher share prices, then I think we'd be in a much better situation to be considering M&A. I'd say right now that's essentially off the table from our perspective. And so, yeah, our focus is keep drilling, advancing, de-risking, and then at the right time, we're open to all options, whatever those may be.
That would have been my next question, because I'm thinking when you move from a project where typically exploration projects, the main question is if this ever gets to a point where it's sellable. For you right now, personal opinion here, it seems like it's a when question. I mean, this thing is sellable. You're proving up large economics. You're getting in bigger companies involved. So it starts becoming a when question, and it really starts becoming a question of how do you extract the most value possible of this? Like how do you not sell it for 1/3 of the NPV or something along those lines? And as far as I understand, exploration is your answer to that.
That's right. Yeah. I'd say this is already a highly scarce project. When you look at the scale, we have over 250 million ounces on a silver equivalent standpoint in the measured and indicated category. So this is a large scale silver gold project. When you look at the latest Silver Institute figures as well, this would rank sort of in the top 10 of large scale primary producing, like on a production basis in the top 10 for primary silver mines in the world. So this is a large scale, project. Importantly, very low cash costs. So this is not, one of those projects where you need $30 or $40 silver to make it work. I mean, at current commodity prices, this has probably north over 35% after-tax IRR, with significant opportunities to further improve that going forward. So yeah, no, we think this is a project that will be built without question in our minds. And so it's, racing against time to unlock as much value as possible before ultimately a construction decision is made. And we have to evaluate sort of options on development scenarios. Again, whether we want to build it ourselves, maybe start off as a smaller scale heap leach project and then expand it through cash flows, or look to bring in a JV partner or various other options. All of that sort of is fluid and will be evaluated sort of at the right time.
Right. At the right time is important here. And that's something that hopefully I can keep getting updates on over time. But it seems, as you said, maybe towards the end of this year or later, what is happening right now is that drilling that we should maybe talk about. Give me maybe an overview of what are you targeting? Where exactly in the land package are you drilling? How deep are you going? And so on and so forth.
Yeah. So all of the drilling historically until sort of 2022 was focused on just one deposit. And so at Diablilos, the one deposit is called Oculto. And obviously it's by far the largest deposit. It's had over 100,000 meters of drilling just within that single deposit. And that's the vast majority of the tonnage and the mineralization sits there. But we ran geophysics across the broader property almost 2 years ago now, identified this magnetic low anomaly to the southwest of that main Oculto deposit. And lo and behold, that's where we discovered this new high-grade deposit called Jack. And so all of 2023, we were busy drilling out Jack. We came out with remarkable high-grade intercepts on a very consistent basis, added 30-40 million ounces of silver through that one drill campaign. And so it was very successful. And now when you look at the pre-feasibility study, you see this Jack deposit has about a 4-year mine life. It's mined out between years 2 and 5. But it has a significant positive impact on the grades. And so when you look at the pre-feasibility study, the grade profile for the first 5 years is over 200 grams per ton. And then it sort of drops off as you mined out Jack and as you mined out the silver enrichment zone at the main Oculto deposit. And so with this year's program, the main focus is on testing some of these other nearby anomalies that could actually connect to Jack, to Oculto, And we think there's significant upside potential there. We're finding more high-grade ounces. So really the purpose is keep that high-grade production profile going beyond year 5. So if we can extend that and have high grades for the first 10 years, that would obviously be a huge, huge win for us. So there's, the vast majority of the drilling is going to be focused around the existing deposits. So we have various zones, Phantasma, Alpaca, Jack North, etc. So we'll be drill testing those, looking for high grade oxide mineralization close to surface, as as our team's been very successful in uncovering over the last few years. But I guess what's really important is for the first time in the company's history, we're now looking to the broader land package that we have. So at Diablilos, it's a 8,000 hectare land package. So it's a very, very large package. And to the northeast, about 3.5, 4 kilometers to the northeast of the current resources, we have this whole porphyry complex that we've never drilled before in the past. And now historically, there's been maybe about 10 holes there, say. These are, historical holes. Well over a decade ago, these were drilled. All of these were very, very shallow. So call it 100 meters, at most sort of 150 meters downhole depth. The majority of those holes hit or encountered gold mineralization, but the copper was leached out. Now, our geologists have done quite a bit of work on that, even though we haven't drilled it ourselves. And, they're quite confident that there's, copper and gold deeper down in the system here. So the historical holes just weren't deep enough. And so we're now planning for the first time, a series of deeper holes, call it 600 meters or so in depth. And then we'll see, obviously, if we're encountering mineralization, they'll even go deeper than that. And so, that's very exciting. So that's entirely blue sky upside potential. And obviously, if we start encountering mineralization there, in sulfides, that could really be a game changer here. Could be a significant amount of gold and copper in that porphyry system. So there's multiple targets, and there's other regional targets as well we could talk about later if you like. Jasperoid, we have not had any drilling done historically. We identified that. There's some geophysics that we completed last year, looks extremely promising, and we're going to be drilling that target as well. So there's some blue sky upside potential here, as well as drilling sort of essentially the known extensions, I would say, of the existing resources.
Yeah, right. So exactly as that news release said, was 75% around the known deposits targeting oxide mineralization. And what just keep on expanding using the formula that has worked so far, and 25% of that would be sort of drilling for that blue sky potential. Across how many targets is that 25% going to be spread in total?
Well, so there's 2 key targets at that porphyry complex called Cerro Blanco and the Cerro Viejo. So those are the 2 main ones. And then Jasperoid is another target. So that's oxide mineralization we'd be targeting there. But that's a step out target as well. So it's, the 25% is obviously not set in stone. If we start hitting some remarkable high grades at Jasperoid, we can move 100% of the drilling activities could be focused there. And so, a rough benchmark is 75% is going to be sort of step out within the existing epithermal district. And we're targeting, a number of holes outside regionally. But again, it's all subject to change. Obviously, if you start hitting some phenomenal intercepts, that immediately becomes a focus. Even the 20,000 meters could be expanded significantly if warranted.
Yeah. How much money is that 20,000 meters going to cost you, by the way?
So it's about 8 million US, about 11 million Canadian.
Okay. Meaning you still have, even after G&A, you still have room to expand it if and where needed.
Yeah. So we're fully funded, even to expand the drill program and complete the feasibility study for next year. So fully funded for the next exploration campaign with a feasibility study at the end of next year, 2025.
I think one thing that I've found online that people really praise you for is sort of being rather efficient in building ounces through the drill bit. I think you've also mentioned to me something along the lines of a few dimes per ounce in the ground in terms of exploration costs, or something along those lines, low basically. How do you think that, I mean, is that something you're actively thinking about? And how do you think that efficiency is going to change once you start focusing maybe on the deeper and the sulfide mineralization stuff?
Yeah. Yeah, no, that's always center stage for our management team, for our board. I mean, we look at, how can we maximize the amount of dollars that we spent on exploration? And yeah, I think we've built up a great track record over the last 3 years. I believe it's for every 11 cents US we've spent in the ground on drilling, we've added an ounce of silver in the measure and indicated category. So not even including inferred ounces here. So it's, among the best, I'd say for sure in the silver side that I've encountered. Last year we had great success drilling out Jack, defining that, growing the resource, and we knew there was significant additional targets with this Phantasma, Alpaca, some of these zones where we were again expecting to hit silver mineralization. But again, it came down to the market was not rewarding us for finding high-grade zones. So we actually shut down the exploration campaign in August, which was a huge shame. I mean, yeah, we could have continued to have great success, but if it wasn't resulting in a higher share price, then why are we drilling these, coming out with the results and not getting rewarded for that? So we decided, look, let's focus on delivering the pre-fees. Let's obviously do a financing on very attractive terms. And once we're fully funded and that sort of overhang has been removed from the story, then we can go back to the drill campaign. And, now I think we've even had more time to review these targets. I think we're extremely confident that, this could be a very, very transformational year for us once again. And yeah, we expect to maximize the rate of return on our exploration dollars for sure.
How do you think you're going to be announcing assay results from this drill program, sort of all at once, in batches, one by one? What are you planning?
No, it's always in batches. So as we get, batches, I'd say every 3 to 4 weeks, we expect there to be news flow. So in the past, historically, we've always had 2 drill rigs operating at one time. This year, we're going with 3 rigs. So again, I mean, it'll just mean that we're still drilling 20,000 meters, but it'll take us less amount of time, obviously. So slightly higher burn rate, but it's important to drill these off quickly, efficiently as possible, and then obviously turn the focus to a definitive feasibility study next year. So yeah, I think there'll be more news flow than ever as we're getting back assay results from all 3 rigs at the same time. I would expect every 3 to 4 weeks we'll have ongoing updates.
And that's on top of La Coipita, because you also have a relatively small drill program going on there. How's that going right now?
Yeah, so so in January, we announced a partnership with Teck. So that's 100% under Teck's. So Teck has complete control of the drill campaign. I believe they're actually wrapping that up as we speak. So their initial drill campaign was focused on about 2,600 meters. I believe they've now completed that, waiting back for assay results. They drilled just 1 target. So there's the main La Coipita target, which was our focus as well. But there are a number of other targets. This is a huge land package, 700 square kilometers. So massive, massive area with multiple targets. And so, yeah, we look forward to Teck continuing to be active there, continuing to drill. And as they continue to advance the option there, they would also make payments to us. So it's, a very, very positive for our shareholders. We're obviously, working together with them to maximize the possibility of a major discovery being made. And that drill campaign is in very, very capable hands. Obviously, Teck's a world-class operator and explorers as well. So yeah, no, we could not be any happier having Teck as a partner, and now at Diablilos, or at the company level, having Kinross, Central Puerto. I'd say it's been transformational for us having these high-quality partners and investors associated with us.
Kinross is also, you guys also have a JV, right? As far as I understand. So they're not only involved at the corporate level, there's also some kind of a JV going on.
Yeah, so there's a broader regional partnership there. So in the event we're looking to acquire additional properties in Argentina, then Kinross has a right of first offer. So we would have to present that opportunity to them, and they have an option to acquire a 50% stake in that project. And then we would split sort of the costs 50-50. So yeah, no, that's again a great win-win for both companies. Obviously, Kinross is now actively looking at Argentina. They don't have any, particular experience, I'd say, in country. And so, through our exploration team, we have a number of opportunities identified. We'll be working closely with Kinross on jointly evaluating these things. And then in the event something makes sense, then we would look to form a 50-50 JV and potentially acquire additional properties. So it's, again, very, very beneficial for all parties, really.
How active are you going to be on that front this year? I mean, that's not center in focus, but how active are you going to be?
Yeah, quite active. I'd say, there are quite a few opportunities right now. I mean, we're extremely bullish on Argentina. I mentioned the reform package that has gone to the House of Representatives, has recently been approved by the House of Representatives, looking to lower corporate taxes, eliminate mining export duties. For our project alone, that would add at least $200 million to the net present value. So it'd be a significant increase on the economics of Diablilos. But also for other projects, of course, in Argentina, you could see significant improvement in economics. And I don't think that's being factored in at all yet. So when you look at share prices, assets in Argentina are still trading on the cheap. I don't think the market's really forward-looking. They're waiting and taking a wait-and-see approach. So we think there's an opportunity, a window that's open right now, where you could, consider acquiring additional assets on the cheap with potential significant upside and not having to pay premium valuations. So we'll evaluate that, but obviously it's not the focus. The main focus is on adding value at Diablilos, working with Teck to add value at La Cuepita. But for sure, we're always looking for additional opportunities, again, to continue to add value for all our shareholders.
That potential tax reform thing sounds like obviously a huge thing. When are you going to know for sure? I mean, is there a cutoff? Is there a date that the government's giving you?
No. So, I mean, it's subject to being approved by the Senate in Argentina. So, but importantly, the first step has already been achieved. So this large reform package, the House was voting on it sort of section by section. So I forget if there's 400 different reforms that Javier Milei and his administration have proposed. But the key one was focused on large-scale investment projects. And so that qualifies for any projects north of $200 million. And so for that, they were looking to reduce corporate taxes to 25%. I mentioned eliminating export duties, a whole host of other favorable measures, improving sort of accelerated depreciation and all of that. And so, surprisingly to us, I mean, that's already been approved by the House of Representatives. So, that's a very, very important milestone. Now it needs to go to the Senate. I think it's a matter of weeks or months. Maybe within the next 1 to 2 months here is sort of what our advisors tell us could be the expected timeline for the Senate to approve that. And then if it's approved by Senate, then of course it just goes back to Javier Milei to sign that into legislation. But that could absolutely be a game changer for all large-scale investments in Argentina. So we're extremely bullish on the country's future, and we think we're perfectly positioned to obviously be advancing Diablilos towards a construction decision at this time.
If you had told me this a year and a half ago or 2 years ago, something like that, I was going to say like, sure, John, call me when it happens. I would not have bought it. So this has been a good overview. I don't want to keep you all day. I know you have stuff to do. What am I forgetting to ask you here? What should we be talking about?
No, I think, look, that was a great overview. I think we're extremely excited with the upcoming exploration campaign as we start announcing results there. I think that's when we have much more information. I'd be happy to come back anytime and provide you and your viewers with another update as needed.
Yes, sir. And you're more than welcome to do that. I'm glad to see the success that you've had over the last couple of years while you and I have been speaking, and hopefully you can actually keep delivering here. Obviously, that's what everybody's hoping for, I suppose, as well as keep me up to date for it. That's what I'm hoping for. So again, thanks for doing this, John. I'll let you drop off now, as I'll be moving away from the good weather in Argentina because who likes sunshine anyways? And I'll be traveling to the north, all the way up to Alaska, actually, where I'll be talking to Morgan Lekstrom, the CEO of Blackwolf Copper and Gold, which, again, as a reminder, has paid for the production and publication of this interview. I don't share the questions up front. No questions are off the table. Companies get no say what will end up in the final video that you're watching or listening to. But still, I want you to be aware of that. Companies listed as BWCG on the TSXV in Canada for now, where an average of about 250,000 shares trade each day with a 52-week high of 39 cents and a 52-week low of about 8 cents. With a market cap of about $15 million and 123 million shares outstanding today, this is a 12-cent stock. There are 42 million warrants and options, making up a total of 165 million fully diluted shares. Management owns about 8.5% of the company, and Frank Giustra is listed as a 13% shareholder as well as a strategic advisor to the company. Looking at the last financial statements, an interim financial statement covering a 3-month period dated at January 31st, Blackwolf had about $5.7 million in current assets, most of which, that would be specifically $5.2 million in actual cash and cash equivalents, as well as some receivables and a small part of a prepaid expense on top of that. In terms of debts, there is a provision for rehabilitation obligations on the long-term liability side of the balance sheet, clocking in at about $1.7 million. And the current liabilities, which are mostly account payables, also sit at around $1.7 million for a total of, you can call it $3.5 million in total liabilities. That same statement tells me that Blackwolf spent about $470,000 per month on average on administrative expenses over that 3-month period, whereas about $180,000 was spent on exploration over that same period, mostly going into contract services, field geology, and that type of stuff. This means that over 70% of the money spent over that 3-month period was G&A, which is to be expected given the seasonality involved with exploring in Alaska, and also knowing that the company was drilling right before that and had results announced at the beginning of the year. So this was not necessarily an exploration-heavy period, but this really only shows you a snapshot in time, and as it always is, it will be your responsibility to head over to the company's website, as well as setterplus.ca, to look at all the numbers yourself and make sure you understand all the caveats and the risks involved in all that. That all said, there were 3 projects in this company. They were all in and around the Golden Triangle up north, 2 of them being on the U.S. side of the border, 1 of them in BC. And Morgan and I have previously talked about these 3 projects extensively, so I'll link to that video, and I'm not going to cover them here in depth, especially because today's conversation will be about Blackwolf's most recent news release, which well, actually, as a side note before the main note, that news release said that Blackwolf is terminating its option agreement on the Harry property as they didn't like what they saw during last year's drilling, I'm assuming, but I'll talk about that later on. And that's the drilling that was announced earlier this year that I mentioned earlier, by the way. But more importantly, and that'd be the main point of this news release, was that Blackwolf will be merging with Treasury Metals into an effort to advance the Goliath Gold Complex project in Ontario, which is a PFS stage project with a 13-year mine life on it, expected to produce about 100,000 ounces of gold annually as it sits right now, resulting in an NPV5 of almost $500 million and an IRR of about 33%, calculated at $1,950 gold after a $335 million upfront capex. All of which, by the numbers, sounds decent, but also maybe a bit of a surprise to shareholders here because, and Morgan, this is maybe where you're going to be coming in, because last time you and I spoke, you had 3 and you still have 2 projects left, which when you were telling me about them, you were excited about growing them through the drill bit. And now this comes in where you're looking into going into production anytime soon. I'm assuming 12 to 18 months or something along those lines. So walk me through your thinking behind this and why it makes sense to do it like that.
Yeah, look, thank you for the intro as well. And let's start with why Niblack fits this. When you look at the valuation of Blackwolf, it truly was set up and valued around Niblack. The 6 million ton VMS deposit, about 770,000 gold equivalent ounces there. Now, Southeast Alaska, fully developed underground, infrastructure in place, definitely fits a direct ship method. But our thoughts were, well, what happens after that? What happens if we go and spend 10 or 15 million drilling it, or we spend 8 million drilling it? what's the next steps? And that's really, we said, well, where do we want to be in 2 and 3 and 5 years? And we want to be on that dev curve where we're taking something into production. And when we looked at Treasury and the compliments that their team have, Jeremy Waith is a 40-year mine builder, tons of experience going in. I have mine building background as well and experience. Jim Gowans, who's used to be the co-CEO of Barrick, like there was a lot of synergy, especially adding Frank to the mix in there, between getting their project into production and then also looking at how we advance Niblack and become a part of a bigger pipeline. So we saw this as an addition for shareholders to leverage off of what we thought was a highly undervalued company for what they have. They're trading at about 0.06 to NAV, which standard is about 0.2. We look at what we have, how much cash we have in the bank, when we'll need to raise again, which, you know, when you say 400,000 per month, there was some drilling and other stuff in there, but Niblack was a higher holding cost. We've significantly reduced that now. So again, when we look at this merger together, we have complementary teams, we have complementary strategy. They may be in different jurisdictions, you know, in North America still, but they do fit. You know, we are able to leverage off of the Goliath complex. We're able to go and put Niblack as a part of that pipeline and really start thinking about it in a more larger flow path state instead of myopic and singular asset. So being a multi-asset company, you get a different rating. And given that TML's Goliath project right now has a federal EA in place, and they're working into the provincial permitting, they're about 12 months away from a construction decision from when the transaction closes. We'll also have a strengthened balance sheet, right? You add our 5 million, you add their 7, you take off a few for G&A and all the other stuff that they're doing on the FS side right now, and then we add 4 minimum in flow through. Look, we're looking at between $14 and $16 million in a balance sheet. That will allow significant advancement of Goliath. That will allow us to reassess what we're doing at Niblack and how that fits together.
Could you maybe also elaborate a little bit on the synergies here specifically? I mean, this is as mentioned earlier, PFS stage project, as I said, decent MPV, but also an upfront CapEx requirement of over $300 million. Not a low number. And also not maybe, well, not maybe, but a different place on the Lausanne curve for both companies, right? Maybe not the best place to get involved in during this kind of a market is what we have going on right now. So how does the combination of these two companies make the synergies make sense, and how do the synergies solve those issues?
I would almost rebuttal back on the best place to get into something in a Lausanne curve. I would say this is the best place to get in on something in a Lausanne curve because they fall off in valuation, they fall off in news flow. So really, you get to a point where you have an opportunity there because once they start going into construction, they get back on the Lausanne curve and they start heading back up, right? So you have this about 12 to 16 month period where the valuation's low enough, where our valuation was close enough that it made sense to merge, bringing Frank in. And look, Frank's original buy build strategy is what built Endeavor. It's what built Goldcorp. It's hand in hand again. He continues to use this strategy. So using TML and Niblack together is just a bouncing board, like a springboard effect for this longer strategy that we're going to be putting in place.
Okay, and then so you're basically bringing in capital to the table to sort of bridge that thought in the Lausanne curve, if you will, and they're bringing you optionality to the upside. Is that how I should be understanding that?
So I think we're bringing in expertise on the exploration side with Rob and other folks in our background. You know, we sit in Frank Juicer's office. It's the Fiore Group. We have about 8 geologists, almost 10 geologists in here now, 16 engineers a part of the group. That is just all part of different companies, but we all work together. So you have a significant amount of expertise. What this will do is allow Jeremy and that portion of the team to concentrate on advancing Treasury into that production state while we get to run corporate M&A strategy. We get to run a huge exploration program that we're planning to show that this is more of a district. We saw this as a big district play. Right now it's 3 million ounces. We think that can grow significantly. We think the grade can increase significantly. So again, they're focused very much on what's permitted. Now let's try to add to that. And that's something with Frank's background and our background. That's why the team-wise fit well.
Okay. Well, maybe you can also just expand about the valuation, though, because you mentioned something about it there, but you're making this deal with a decent amount of cash in treasury, as I mentioned, and a much larger amount of money already invested into R&D, essentially into your own projects. You have that team and so on and so forth. How do you look at the valuation at which this is happening?
You look at, so for me, I looked at our cash position. We looked at what our plan was to go back to Niblack. We looked at the plans that we had with Harry and with the Cantu side on Hyder. And you look at cash distribution compared to market conditions. Usually in these types of markets and going for the next little while, the juniors with a non-development stage asset are the last ones to get back on track. Let's say, I'm air quoting here, back on track into evaluation curves. So you want to be higher up in that dev curve. So when we looked at that, we said, okay, we hit 8 cents. We're at 13, 12 and a half, 13 when we were doing the deal, 14. And we said, we have from our valuation standpoint, from cash standpoint, we could go out, we could start drilling Niblack. We could burn through our cash fairly quick. We still had some flow through that we had to run through. So I looked at it and said, we have an opportunity here to either put a bunch of money into our assets and hope the market recognizes it, which 50-50 that it will, right? Because they are great assets, but it still came to the point where I've seen great results downtick stocks. So at 13 cents, do I want to go raise another $5 million? Absolutely not. Like, that is detrimental. The other option was to stay and do nothing. Well, there's a cost to holding Niblack. There's a cost to G&A. So instead of shutting down and just getting rid of everybody and putting the company on pause and hoping that the stock doesn't fall to 5 cents, which is a horrible strategy. It's a part of a strategy, but it's a horrible strategy. We looked at it and we said, well, from a valuation standpoint, we think coupled with treasury that we're going to give our shareholders the potential 12-month, 16, 18-month upside that's going to come with their dev curve changing. That's going to come with showing district scale potential. And then going back and looking at Niblack as a part of a bigger plan. So we looked at the valuation as, people can pay premiums. There's been people getting taken out for large premiums in the market. There's been people taken out for no premium in the market. If you get taken out as a premium, and you can see this over and over and over, and this is, you talk to Rob McEwen, you talk to Frank Justra, they generally don't do premium takeouts. They do it at par, because then you don't trade a huge arb and you're not messing around with stocks. You do it at par, you get a plan going, and you work the plan, and you make all the shareholders money on the way up. That, to me, I like that method. I like that model. It worked really well for this transaction for us so far. And it's going to give both shareholders, I think, a lot of upside of, having Frank come in and say, this is a valid mine. It's 109,000 ounces per year, but the first 7 are 125. We think we can change that significantly. And then again, going back to Niblack, maybe it's a 3 or 5 or 7 year mine life, but we needed time to do that. We needed money to do that. And just diluting us down to do that right now, I just didn't see it as a smart shareholder decision.
So essentially, Niblack is now it's going on the back seat, basically on the back burner. Like, you're not going to be doing much there before you have a mine built in Ontario.
This will be 12 months away, 13 months away from construction decision at the outset of closing this transaction. So we may do some geophysics there. There's some geophysics we'd look at doing. I was boots on the ground a couple of months ago there. Again, great project. We did advance it through this transaction, which most people didn't read, but we actually bought the infrastructure there. We bought the camp. So that is now fully owned by us. We settled out. There was a payment to Teck that on a transaction or on any type of production, we would have had to pay. So we settled that out. So we actually did a lot to advance Niblack without putting, drills on the ground, in a sense of setting it up for a future. It is now set up with the infrastructure fully paid for, set up with the underground fully built, that when we want to go in there, it's a much quicker process and much simpler than what it was before.
Okay. What do you need geophysics for, by the way? I thought Niblack had drilled targets already.
It does, but we wanted to identify other sulfide shoots. So VMS deposit usually has multiple lenses. We wanted to try to identify those with geophysics. It usually hosts pretty well for that.
Okay. Is that a maybe, or is that already a planned exploration program that you're going to be doing this summer?
That was a planned exploration program, but now as a combined team, we're going to be assessing again, do we want to do that now or do we want to do that in 3 or 4 months, right? We have good windows with Niblack because of its location. I was there in January or February, like it was +5 out and there's no snow on the ground.
Really?
Yeah, Southeast Alaska. It sits down near about the same level as Stewart, BC, so about halfway down BC, but it's in a coastal range. So it does get snow, but it's mainly accessible all year round.
Okay. So you're not spending any major money on any of the Blackwolf projects this year. The focus is going to be drilling out Ontario. What are you doing in Ontario? How do you want to expand it at depth, along strike? What exactly are you drilling?
So between Goliath and Goldland, so Goliath is one of the main pits, Goldland is the other one that makes up the bulk of the reserve being mined. There's 3 million ounces between the two. There's about 1.2 million that is currently set to be mined. There's 36 kilometers between those two pits that have been very underexplored. They've had sampling, they've had geochemistry, but they haven't put drills in the ground there. Like you're on about a 47-kilometer strike length between Goliath, Goldland, and Miller, with proven targets, with proven that Miller is expandable. So you have this district scale that hasn't been drilled in a long time. We're going to go, use that flow through to drill it while advancing that provincial permitting. So you're kind of creating a dual path. And you're right. It's not that we're sidelining Niblack at all. It's that it's now becoming a part of a pipeline. And that's a key part to remember. You have a bigger asset that'll have cash generation. And instead of diluting to go to Niblack right now, we get that thing into cash generation. Then you add Niblack in as a part of that pipeline. And to me, it makes sense. You want us as a mining company or as a junior into a mid-tier or a junior into producer, your goal should be always to stop dilution as fast as possible, right? So that's either through a buyout, that's either through building, and that's through major discoveries, right? But that's still, even with major discoveries, you're diluting to raise capital.
How much money do you want to spend this year in total then across all the exploration programs?
I would say currently we've said we're going to raise 4 million flow through. That may change a little bit in the next few days. We don't know. There's been a lot of interest. I think we could spend anywhere between $4 and $7 million pretty easily. That would give us a very large 18-month drill program that would show a lot of scale potential, that would convert a lot of the ounces potentially and add to the ounces into higher grade ounces. So a part of Goliath and Goldland that I found really interesting, that our geologists found interesting, was when you look at the pit shell and you look at the very bottom of the pit, it actually gets higher grade. As you go down at depth there, and it's wide open at depth, it starts to get higher grade. You're talking like 5, 6, 7 grams, and it just hasn't been touched down deep. So you start to drill deeper, you start to show strike length, and you start to show strike connection between Goliath, Goldland, and Miller. Now you've got something that a mid-tier or a major would be like, hey, there's a huge district there. Like, what are we missing, right? And I think that's the dual path we're going to run, right? Jeremy and the team and our team are going to look at, again, advancing Goliath into that construction production state while we advance the exploration, showing the large-scale potential that we know is there.
When you combine those two companies, what's the treasury going to look like on the day of combination? You have what, about 4 million now?
We have 4.9, 4.8.
Okay, good. 4.8.
Yep.
They don't have much, I don't think.
They have 7.2.
They have okay, December they had 9.4. They spent about 500 grand a month, I believe, on G&A. So they do have indeed.
I would qualify G&A with they're spending that on feasibility study. They're spending that on environmental permitting. So they roll that all into G&A because it's just it's people hired to do this, but they're advancing FS study. They're advancing environmental and all the permitting for the provincial permitting. So it's a higher burn right now because they're advancing those stages. And if they were to pull it all back, it would be much, much lower.
Okay. But so on the day of combination, let's call it 12 million bucks, give or take.
14 is what we've slated. 14 million on the day of combination.
That's going to be with the flow through.
Yep.
Okay, 14 plus the flow through, because I was going to add the flow, and then you want to spend 7, you see, on exploration, and then the rest is going to cover. Is the rest going to cover the new G&A?
Oh yeah, we're not adding much. We're adding almost nothing in G&A, just myself.
How do you mean? So the G&A from Blackwolf that is going to cross over is just going to be basically your salary?
Yeah.
Okay.
Essentially.
What happens to all the rest of the G&A? Yeah,
well, all the
marketing,
listing
offices,
fees,
people.
exactly. So all the listing fees, all the fees that go along with audit, which is not cheap, that just gets, because it's amalgamated, it's now one company, right? We just go with them and do theirs. It's all becomes a part of one company. It's no longer split into 2 different separate G&A categories, but it's also, we're not paying 2 listing fees. We're not paying all these other things. The office expense is very minimal. Like my office costs $1,500 a month. Like we're not talking a huge amount of dollars for that. The other side of it is, I would say, stay tuned on the flow through side over the next couple days. I mean, look, we went out to raise 4. We want to have enough money in the treasury right now. It's a bad joke, treasury mining, but we want to have enough money in the account that we can spend $7 million in flow through, and that would give us 35 to 40,000 meters of drilling in Ontario. And you got to remember, flat, you can drill winter, you can drill summer. There's certain areas you want to drill in the winter. There's certain areas you want to drill in the summer. And that, to me, creating a long-term news flow while you're in that part of the Lassonde curve will help change the dynamics of this company for both shareholders.
With that treasury joke right there, I'm starting to get concerned about your mental health, because that's typically a joke that I would make, and if you're getting to my level, then maybe there's something wrong.
I do have a 5.5-year-old, so probably.
Good point. I don't even have that. Well, I have one in my head, somewhere in the back of my head. You're moving from CEO to president now. What's that going to change for you specifically in the tasks within the company? But also, are you getting more money, less money, same money? What are we talking about?
Let's start with the dynamics, the team dynamics. And that's a key thing, right? They're a double, if not 2.5 times size of our company, right? So you have a 40-year mining veteran as a CEO that has built mines all over the world as a current CEO and president. You have Jim Gowans, who's on the board, who is ex-CEO and co-CEO of Barrick, on the board of Cameco, arguably the most notable mine builder in all of Canadian history, like very, very predominant fellow. And they don't know me, right? They don't know me yet. I'm getting to know their team very well. And Jeremy and I and Oren, the CFO, and Rachel, one of the VPs, have a very good working dynamic. So we've split the roles up. So Jeremy is going to really concentrate on advancing Goliath, advancing permitting, advancing engineering, doing what he does best. We're going to take the other side of that under the president role, which is we're going to do the strategy, the M&A strategy. We're going to run the marketing strategy. We're going to run the finance side through Frank, right? Like having that dynamic there, allowing people to concentrate on the area of expertise. Because in reality, when you get to a point that you're building a mine and you don't have that other side of it, everything can become a problem very fast. This is where companies fail. We're trying to set this company up to have high level of success. And so you never know. You never know if I will be a CEO one day again of it. I'm hoping so. Look, I'm very happy to be a part of the team. I'm very happy to be a part of a big story and be a part of a pipeline and be a part of what, Frank's really put together over and over and over again successfully. I mean, that's a really good position to be in as a young executive in this industry. So, CEO of a $15 million company or president of a $62 million combined company with a path to production, I'm happy to do whatever is needed in this role. And you never know what'll happen. I think there's a path.
But a CEO of an Explorer Co and a CEO of a producer or a to-be producer is 2 completely different tasks, and they need 2 completely different skill sets, right?
Correct. And my background is around the mine building industry, right? I worked for Freeport. I worked with Rio Tinto Mongolia. Like helped put mines into production in Africa. projects in Canada, Peru. Like that was my skill set prior to coming into the capital markets and the executive roles. So I'm looking forward to learning a lot from Jeremy and their team on the operations and building side, but also having the technical side myself helps out a lot with that, right? So really, you're not just having an Explorco team now, you have a mind building and operating team with Explorco experience.
Okay. But then you just said that only you're going to be crossing over as part of the team.
Part of the executive.
What's that?
As a part of the executive, yes.
Oh, okay, but so you're going to
we'll
have
have
some
a lot
your,
of board members.
and what about your geos? Because I mean the people who worked on NBLAC and your property specifically, they're the people who know those properties well, you know, basically inside and out. Are you taking them with you? Like who's going to be dictating the tempo for exploration on the Blackwolf side of things?
Yeah, so I mean, as we merge together, we will have some of our geos that, you know, come into the team, or the way we operate was a consulting model. So they were consultants as needed when needed. That's how you generally save money as an Explorco. Rob McLeod's coming over to be on the board, so you have that exploration expertise. You have Andy Bowering most likely coming over to be on the board as well. So that, again, another positive, myself being on the board. And we do have an open board spot we're looking for to add to it. So as we advance the assets, this next 2 months is truly about setting the next 18-month plan up. So we still have our team here. We still can work together and are working together as a team, but we're working very closely with their group. We don't skip a beat. I talk to their group. I talk to Oren, or I talk to Jeremy. Jeremy's on vacation right now, but I talk to them 3 times a day. You know, we have a call in the morning at 5:30 or 6 our PST, and then I have a call at the end of the day, and we work very well together. There's a very strong dynamic there already, and that's from me spending time in Toronto with them spending time here with us, them spending time with Frank. So again, this wasn't something that we just kind of slapped together. We took a lot of time with both teams and making sure there's synergies there.
Okay. In terms of permits and all these things that you have to get going before the exploration program is active, what do you have now? What do you have to get?
They're permitted to do the level of exploration that we want to currently. We are identifying more points we'd like to drill, but again, I can't overly comment on that until we have that full plan in place. But we're currently permitted under their permitting regime to do what we need to do in the exploration drilling side. There are some other areas we want to go drill, so it's only a month or two to get that permit. We're not overly concerned about that in what we consider probably an 18-month drill program.
Okay, so that sort of in terms of permits, I always like saying or thinking to myself that you need permits and then you also need permission to different things, as in from the locals, birds, fishes, and everybody has to be happy up there. Well, how's that looking?
Really good. I have to say, you know, Rachel Pino is an exceptional person at First Nations relations and community relations. She spends a lot of time in the Wabigoon First Nation. She spends a lot of time with all the other First Nations in the area that we're dealing with, and they're making significant progress. I definitely, that everyone is seemingly so far in support of what we're doing. They're in support of the project advancing. It creates jobs for everybody. They use a high level of First Nations integration of help into the drilling and into their exploration. So from what I've seen so far, the social license side, they're doing an excellent job. I really do think that. Also having Rob McLeod come and join the board, an exceptional relationship with First Nations generally across Canada. He's done a very good job and spent a lot of time with the First Nations every community. So that only strengthens that. But I give a lot of credit to Rachel and to Jeremy, because both of them have been involved in IBAs. They've both been involved in First Nations consultation in the past with the Victor mine. So I would say we're in a very good position with strong people to do that. It's not fly by night, and it's very well planned.
So essentially you can go ahead and drill once you have that plan and everything lined up. But so you have permits, you have permission, and you have money to drill this year. Last thing left for you to do is come up with that plan. When do you think you're going to have it?
I would say as we come closer to closing, and on closing, we'll start really talking to the market about what the bigger plan is. We're working on the exploration side. We're looking at a bunch of different options as well on the mine building side, grade control side. What we're doing on the feasibility side as well. Jeremy and them are working on the feasibility. So I think you'll see some very nice, how do I say this without overleading? I think you will see some very positive work and positive news coming out of combined company, or we call Newcore right now, over the next little while. Like this is the story that is not only about to get going, but it's about to get going with one of the biggest mining finance guys and mining, company builders in the industry that has implemented the strategy over and over and using a buy build that makes sense for Treasury now.
Are you going to keep the name? Because you said you're calling it a Newco right now. But are you going to keep the Treasury name?
In the press release, we called it Newco, as in MergeCo kind of thing. We like the word Newco better than MergeCo. We're contemplating on rebranding for sure. I think there's a bigger brand to be had. We are looking at multiple avenues there. So it's
interesting.
It's going to be fun. Yeah.
Okay. I'm not going to push it too much, so I don't assume you can tell me. I don't assume you can tell me too much, but as long as you don't call it 5-year-old gold, then it's fine.
Oh, yeah. Well, I'm not going to name it after my son either, That's just bad news.
Good. Morgan, this has been a good overview. There's a switch of strategy, but it seems like you have the ducks in a row to continue doing this. So I'll be looking forward to more conversations in the future. What am I forgetting to ask you here, though?
Well, Morgan, what's the weather like in Vancouver? And I'm going to say it's sunny. No, you know what?
I could say the same.
I don't look. There's been a lot of phone calls and a lot of mostly very happy people calling, being like, wow, we're a part of a bigger story now on the Blackwolf side. Treasury's shareholders, and maybe I'm speaking a little out of turn, but talking to Oren and Jeremy, they've been getting very positive calls. Their biggest shareholder right now is Extract and First Mining. If you've noticed today and yesterday, we've been actually working with First Mining to start positioning bigger people that can help on our side with the mine build type financing and stuff. So we've not convinced, but we've worked with First Mining in their large share block to be able to transfer that over into other strong hands. So, Dan Wilton and them at First Mining have been super supportive of this. They've been working with us on that cross. Sprott's been super supportive because they know that now that you have a more combined company, you have more horsepower on the finance and the market side and the M&A side. This thing has a real shot of being a mining company. You look at someone like Orla Mining in Mexico, they're producing 115,000 ounces a year. They're what, 1.2, 1.4 billion, $1.7 billion company today. This thing will produce for the first 7 years about 120,000 ounces a year. So that gives us 7 more years to add ounces, grade, and it's about 6,500 tons per day. So it's not small.
Well, I hope you're going to keep me up there. I was trying to see what you were talking about here, because this is also something that I was wondering about is the institutional side of the story. Are institutions on both sides happy? Are they staying shareholders? What are you doing to keep them there? What are you doing to keep them from, rocking the boat here in terms of share price?
Yeah, look, we've met with every one of their large shareholders. That is over, the over 10%. We had Frank, we had myself, we had their teams as well on the calls or in person. And again, all very supportive and very happy to have something now that has legs that can grow really quick. So, and on the Blackwolf side, the general support I've had from a lot of our larger shareholders have been, especially Frank holds a significant holding here, is that this now has becoming a part of a pipeline. It has that quick growth potential because, again, when you go into these construction and when you start showing a wrap up, like, this buy build strategy, the valuations change very quick. They get re-rated very quick. Your valuation to NAV changes significantly. So we're looking forward to that in the near future. With gold running, these are the types of stories that will benefit much quicker.
All right, Morgan. Well, I appreciate the overview, and
Thanks.
Hopefully we can do this again soon. Thank you so much for stopping by today.
Thanks a lot.